Okay guys, let's get started. Welcome to the 5th edition of Better Call Show by Idea Pattarai. And this time we have Hariharan from DSG Capital. Right now if you're doing this probably in Bangalore, it will be national news. We have lost some of that PR race in India.
95% of consumer brand exits in the last 15 years are not unicorn outcomes. The fact is we've been investing in consumer brands for over 15 years now. We've invested in more than 80 brands, but so far we only have 2 investments in Chennai. Most recently, we invested in this brand called Secret Alchemist. The actress Samantha is a co-founder. That is a product that served a personal pain point.
Do you see the quick commerce as a clear channel to actually build a powerful brand from day one itself?
Key is that you have to continue investing in brand outside the platform also. Even the QCom guys, we work with all of them.
Yeah.
They have this term called cart breakers.
Big market, great product, great marketing or great founder, which do you compromise on?
More than 50% of the work we do is on the founder, because if we back the right founder, they'll make magic happen.
Now, what does DSG expect? Do they expect a pitch deck? And if so, what should be in it that says, okay, this is the right founder?
No, actually, for us, the pitch deck is not as important in the scheme of things, because if you have a kick-ass product, especially in food, you come to the meeting and make us try the product, that is like more than half the job.
That is the pitch.
Yeah, that is pretty much the pitch.
Before we get into, what you're doing currently, I want to go back and ask some, light-hearted personal questions and say, did Hari think about becoming an investor when he grew up? Like, I always am curious of how does a child think that they want to become an investor? I don't think that child thinks like that. So when was that point when you thought, okay, this is what I'm going to set out to do for my career?
Yeah. First of all, thank you for having me. Really happy to be here, and I'm from Chennai as well. So always keen to help in whatever way possible. And I'm hoping to see a lot more consumer startups out of Chennai. I liked what you said. The fact is we've been investing in consumer brands for over 15 years now. We've invested in more than 80 brands, but so far we only have 2 investments in Chennai. It's like it's Indus Valley, and there's another one actually yet to complete, but it'll complete in a month or so. But most of the portfolio is Delhi and Bombay, and the only reason that I often joke about it is consumer requires a bit of flair and a bit of extroversion, and Chennai is still on its intellectual pursuits, and they consider those things below their intellectual level. So I hope it's actually not, and I hope it's changing fast, and looking forward to seeing more brands out of here. But coming to your question, I'm surprised that you didn't know investing is the greatest calling for mankind. No, I was just joking. I don't think anyone starts out dreaming to be an investor. I was another Chennai boy. My mom was a doctor, dad was a scientist. So I was dreaming about being an astronaut. And then I think somewhere along the line, my love for math took over, and I ended up going to College of Engineering, Hindi, did engineering. So that was my growing up years.
Okay. But at what point did you move into becoming an investor? Was there any like an inflection point or a trigger said, okay, this is where I see myself building, my career?
Yeah, the way I got into investing was, I think it was quite superficial, the pursuit at that point. The honest truth is I wanted to get into IIT Madras. I didn't make it. I landed up in CEG. So the next best ambition for me was to definitely get into IIM. So I ended up in IIM Bangalore. And investing was the most sought after job on campus. And that's really the reason why I pursued it at that time. Okay. But eventually, I realized that, while it does seem glamorous from the outside, most of you are founders in the room. You know how hard the journey is as founders. While an investor's journey is not as hard, it is almost as difficult. You realize what a roller coaster ride it is, and it's not just the glamour of, sounding intellectual, traveling, etc. You are actually with the founders during the worst of times. So despite that, I realized that, it's also a career in which you get to work with very interesting people, very driven people. So that is like a really big attraction. And I also think investing is probably one of the few jobs where you're paid to learn. And I tell this to my team all the time, because in our profession, if you stop learning, you become redundant super quickly. The founder is not interested. Your advice may be relevant for a business that started 10 years back, not anymore. So for me, literally, if I had to distill it down to two reasons, I love investing. It's working with the best people, and you're just paid to learn. And if you love learning, then it's an amazing job.
I think I really resonate with that, because when I moved into venture capital, the only joy that I get is I get to meet exciting people every day. You don't know what's going to come in the road, right? And these founders come up with the most amazing ideas that you've never thought of. Something from waking up, there's a problem, to solving space level problems. And I think that's phenomenal as a journey. But, it's interesting that you said, you didn't get into IIT, so you went to, CHU, Sana University. So it's like across the street. So I think that's a backup. And
It's a great college. Yes, it's not taking away anything.
I think it takes rejection from IIT to understand Apna University is better, I guess. But great. I think I like that journey. Since you never set out to become an investor, and you probably I didn't shape you into naturally doing that.
What was your idea about startups before you became an investor, and what has changed?
Like, did you know about this word, or were you like just fresh into it?
What was your thoughts? And sorry, what year was this? Just to get to know.
2010.
2010. Okay.
Yeah. So, maybe I'll give you some more color on my journey. So back when I was in campus in IIM Bangalore, Flipkart was a startup back then. And I remember Sachin Bansal showing up for placements, and there was zero interest in the batch to join him, because it was just a startup and no one knew what a startup. I'm Bangalore. Yeah. And I remember Sachin Bansal, pitching it hard, etc. Probably, even in my batch, the people that joined Flipkart, I don't think it would have been their first choice, when they ended up joining. So that was the world, that was when I was in campus. So my first interest actually, I got into investing in the private equity side, not in venture capital. So private equity, as you know, is more mature businesses. So that was the most sought after job back then. VC was still like relatively unknown. So as I said, I just followed the herd, and I wanted to get the best job, and ended up in BE. And I was a generalist starting out. So initially, in the initial part of my journey, I used to, I have a computer science engineering degree. So I used to do everything from tech, SaaS, consumer, etc. But despite being a computer science engineer, I realized that I was having more fun with consumer startups. And then I just started following my heart after a certain stage in life. I just was looking at where I'm enjoying the most and following that. That's when I got introduced to the founder of DSG Consumer Partners.
Okay.
So it was consumer. It was early stage. I had no clue about early stage investing, but it was also the responsibility to run the India office for India's first consumer fund.
Okay.
So it was very compelling, and I just wanted to give it a shot. I knew it was consumer. I knew Deepak, the founder, was a great guy. And I remember, my wife Pallavi is here. She used to be at Kiss Flow in Chennai. But I just moved to Bombay to a fully furnished flat, not knowing whether I would enjoy early stage investing. We said we'll give ourselves a year so I can come back. It's easy, just with a suitcase, etc. But a year in, I realized I really loved the early stage investing. I think what I really liked was, in PE, the business is almost formed 50-60%. So your influence on the business is only so much. It's more around, say, cost reduction, more around the financial aspects, and more around squeezing efficiencies in your business. As opposed to early stage where it's completely fluid. It's a blank canvas, and you get to dream with the founders and really influence founders in a meaningful way. But I think the most important thing is I can tell you now that it's been 8 years at DSG. In the early stage, the investor-founder relationship, at least for me, has been more as a friend than anything else. So it's like, I know that these are founders, I'll be friends for life, and we've been through all the good and bad days together. And yeah, so that's sort of how the journey is panned out.
Great. So I think from People Capital, you left and came to DSG. Reason is the private equity.
That's good. It was a buyout.
Yeah. So 2018 is when
DSG started India operations.
No, DSG started from 2012. So initially, the first and second fund, the founder Deepak, he was managing it with like very junior people. Okay. 2018, he's based in Singapore. Yeah. But 2018 was when we were raising our fund 3, and he wanted someone senior to run the India office, set it up. That's when I joined.
I think you by then had done 8 years of investing at least.
Yeah, I think that was.
So anything that you learned from people that helped with DSG, or it was completely
I think there are many that that I could carry on to DSG. Like in People, one of the investments I made, which I'm most proud of, is this childcare brand called Clay. KLAY. I don't know how many of you know it. Yeah. So they are the largest childcare chain in India today. And we invested in them, when they were literally a startup. Right?
Oh.
It was to date, I think it's been my most fulfilling investment because, for especially the women in the room, you would know this, in nuclear families, the importance of childcare and what that means to ensure you're able to pursue your career without, compromising on it. And Clay was also an organization that had 99% women. And most of them were women coming back after a break. So much that there was a point when we had to hire men as diversity hires, So it's a firm that continues to be very close by heart. But some of the lessons I learned through the Clay experience was Clay was a services company. Most investors don't like services businesses. They always cite reasons that they don't scale. Yeah. So many reasons, but Clay did phenomenally well. People has still not exited it, but I know whenever they exit, it'll be a great, phenomenal return. Yeah. And People was a buyout fund. So we used to be a lot more hands-on with our companies. Okay. So everything from hiring and again, problem solving. I would say half of our role as an investor is just problem solving with the founders and being a sounding board. So those skill sets, attitude are things that I carried on to DSG CP as well. And I think among the VC firms in India, we would be probably amongst the most hands-on with our portfolio because I truly believe that capital today is a commodity. Founders are not coming to DSG CP for the money we bring. I'm sure just the SaaS founders in Chennai would be able to write checks that we write, including people in this room. But the reason they come to DSG CP is what we bring beyond capital. So that means, being there for the founders, your expertise,
That's great. Thank you. Because I was also doing a lot of research on you and DSG, and something struck me that I really liked that was there on your website, that you were saying building insurgent brands. That's a really nice statement. Can you just dwell on what you mean by that? What do you mean? What is an insurgent brand according to you?
Well, insurgent brand, the way we define it is, think of it as a new age brand founded in the last 15 years that is solving either an unmet customer pain point or solving an existing pain point much better than an incumbent, right? So that's what we mean by insurgent brands. We hate this term D2C brands. It just something that we get annoyed about, because D2C is just a channel. Like for some reason, it's just gained so much traction. Not just a category, like any new age consumer founder identifies themselves as a D2C founder. Like D2C more often than not is less than 5% of your revenues, etc. Right? But that's how it's an Insurgent brands, and we are consumer founders. We're not D2C founders. Yeah.
Can you tell me why did you name it DSG? I didn't get.
I don't think there was a lot of thought put into it. So it was just a founder's investment vehicle. So he continued DSG and he added consumer partners. Consumer because we only do consumer. We don't do B2B. And there was a reason we called it partners and not capital, because we truly want to be your partners in the journey, just not some abstract money back giving you money.
Okay, so that's we were very specific about DSG considered partners, and that was very strikingly unique.
No, we preach to our founders that it's all about focus, so we have to lead from the front. We can't do everything under the sun.
Nice. Okay.
And for those in the audience who don't know DSG's portfolio, like some of the neat brands are like, Epigamia, Oyo Rooms, Chai Point, Sula Vineyards. These are some of the brands that DSG has done, which is all like brands that we use and touch on a daily basis.
But I'm curious, how many of you knew of DSG CP before you heard from MudhalVC?
It's not bad. Chennai knows everything. We just don't reach. Yeah. So moving on, I want to take a quote that you had said. I think this is what you said. Maybe correct me if you're wrong, but it's on your website. So you said like a consumer brand will take longer than a tech business to achieve similar scale. However, if the consumer brand consumes a fraction of the capital as compared to the tech business, the returns are similar. And most importantly, the consumer brands avoid the high-risk approach of pursuing a billion or bust trajectory. This is something I think you authored it, I saw it in my I think this is really nice. And it gives a lot of confidence for consumer brands, for entrepreneurs to think consumer. Because in the words of where I come from, there were two thoughts about tech and consumers. The people like, Andreessen Horowitz, who said, the only companies that ever scale largely are tech businesses. They come from that school of thought. So immediately a very novice entrepreneur or guys who are starting off, whether they have the domain experience or not, they're like, no, I only want to build tech businesses. Because those are the only ones that we see smart. This is the narrative that's pushed maybe from Silicon Valley or what we also believe. Then if you look at people who are enthusiastic about consumer brands, the only brands that they think about are PG, the brands that, our mothers use or our parents use. And those are such large businesses. Traditional takes 40 years to build. You will be like, you won't have that, but then you succeed. This is another narrative. And I think entrepreneurs get stuck in between these two. I really love this quote that you had mentioned. It gives so much confidence. Like, you don't need to worry about becoming a $1 billion company if you build something really frugal, something that clearly solves a consumer problem. And you do it well enough, the consumer market is actually much, much larger than the tech business.
When did you actually arrive at this quote and, your thought process behind this?
Yeah, actually, I think I should trademark that quote because it's like something I am very, very passionate about. And I missed covering this. That was also something that gave me the confidence of moving to VC from PE, which is, my articulation of our strategy is that we are a hybrid between a private equity firm and a venture capital firm, where we marry, in the early stage, you do need imagination, you do need the art of the possible, etc. We marry that with the fundamentals discipline that a private equity firm brings to the table. Because in my experience, and, I highly encourage all of you to check out our website. We started this research work with Bain & Company, where we researched all the consumer brands in the last 15 years to distill patterns in the ones that are successful. And there's some very insightful findings. We can maybe share the link
Sure.
post this session. And one of the data points which we knew that came through in that report is that, 95% of consumer brand exits in the last 15 years are not unicorn outcomes. So, when usually, like you mentioned, when I'm sitting with founders in pitch sessions, I almost see a palpable, tension, pressure in their faces to show a unicorn outcome. They think that, if I don't show a unicorn outcome, this guy will lose interest, right? And that's so unfortunate because, as I told you, the data points to the fact that consumer brands are not unicorn outcomes. Not that they'll never be, it just takes time. But the most important metric is, while they are not unicorn outcomes, if you look at the value creation that happened for founders, more than 70% of the cases, the founders owned 60% of the business at the time of exit, which meant even at a $200 million outcome, founders made hundreds of millions of dollars, right? This is as good, if not better than 6-0. Yeah, because in consumer, one can, you bootstrap your business. In consumer, it's possible to be very capital efficient. And that's something I harp on relentlessly with my founders. Don't be on the capital raising treadmill. You can get to profitability. The data shows that. And you can make as much money or more money than unicorn founders at even 100, 200 million EVs. Right? But the key is to do it frugally and not to chase that growth at any cost trajectory. Because I've just seen that more often than not, chasing growth for growth just adds a lot of risk to businesses. You might need it if you're building a Facebook or maybe even a Swiggy. But in consumer, it's never a winner-take-all outcome. So it's not about the last man standing. You can always have your core loyal customer base and run a profitable business, just catering to them. And in consumer, you don't have the tech obsolescence risk also. It's like most of us still use the same toothpaste our grandfathers used. So there's no one coming after us. You don't have to look behind and try and grow fast. And the third thing is, in consumer, you monetize on day one and you have positive gross margin on day one. You're not like garnering eyeballs and then figuring out business model later. So if you just tailor your cost structure well, run a tight ship, you can build capital efficiently, not dilute too much of your stake, and make as much money as unicorn founders without putting yourself on a risky trajectory. So that's like a very long answer, but that quote essentially captures that thing. And that's what differentiates consumer brands and consumer investors. I know that I'm probably amongst the 1% or maybe the only one in the VC ecosystem that will talk this language.
Yeah, I mean, it's unlike a VC. But it actually is very gratifying to hear that, and I think that's a very positive take that founders here should take, to think about, because every time I've heard about consumer brands, they're like, I don't have economics to do $1 billion, how will I get VC money? Like, this is the only frame you work in which they even think. And when you can hear like a tier 1 VC come and say this, I think it's instilling a lot of confidence for us. It's like, okay, we probably can do this too. In fact, the best example is probably Minimalist, right? The recent acquisition. They built frugally 6 years, got to 500 crores. Then, I think Unilever bought them out. So that's a great story.
Yeah, just to add to that, like even Minimalist, I don't think all in required more than 30-40 million of capital. And we have all those interesting data points in the research we did. The other thing I must highlight is consumer requires patience. One important data point for everyone in this room to know is, on an average, it took 6 years. 6 years for a brand to get to 100 crores from inception. It takes time. So one shouldn't be in a rush. And I again see this issue with founders because, either themselves or they think VCs are not excited by the, that kind of growth trajectory. They're under a lot of pressure. It takes 6 years to get to 100 crores. But the interesting thing is the growth from there, 100 to 300 on an average took 2.5 years. So the compounding really kicks in after the 100 crore mark, provided you built the foundations right. And as a fund, we invest in that 0 to 100 journey. So it's important that we are patient and we are not pushing, asking our founders for week on week growth targets, etc. Right? So I think you should check out the report and
You said it because when I looked at the website, I thought it was one of the most well-written, VC websites I had seen, because most of the other website I've seen is a lot of marketing language, like we put it on, Mavericks and all of that. And here it was a lot to read though, but it was actually a very well-written website, including the philosophy page. I really enjoyed it. So, kudos.
Glad to hear.
Yeah, I really enjoyed it. So, there was also one more thing that you already mentioned, saying your website clearly says, we want patient business builders. We're very clear about that. We are in no hurry. This is the other side of the coin question where, for you guys to raise your funds, how are your LP relationships though? Because don't they
have a different kind of IRR expectation and be like, because the other fund is like giving it at such a rate. Is this a problem for you?
No, that's a very, very relevant question. Our LPs don't expect anything less. But the interesting thing is most of our LPs are, really large consumer family offices, and we've never raised money from India. So these are people who've seen market cycles, okay, understand what it takes to build a consumer brand. But that said, the way the fund math works is, like if I take our, most recent fund, like Fund 3, of the 10 investments we made in the seed stage, 7 of them are now in the growth stage. Right. Wow. So, the hit rate that we have is like far higher than what a tech fund would have. Tech fund would probably have 1 or 2, and that'll be a massive home run. Yeah. Whereas for us, these 6 or 7 won't be home runs, but they'll all be, in my view, somewhere close to that minimalist outcome. Yeah, they're all in that 200, 300 crore revenue with profitability, etc. So that is how the math works. For us, the hit rate is a lot higher, and it should be. A consumer brand should not have as much risk, mortality risk as a tech business for the reasons we already covered. Yeah. And that's what I tell our founders as well. Partner with us and we'll strive for you to be in that 70%. It can never be 100% because we do get a few calls wrong. But that's sort of how the fun matters.
I had this. I wanted to confirm with you because the hit rate is better. And wow, 7 out of 10 is amazing though.
They're very, very proud of that. Yeah. So I can always look in the eye of my founder and tell them that we have your back. We won't push you into a risky trajectory. First job is to get you to be a real business, right? And then we figure how big it'll be.
Great. Amazing. So
I wanted to clear some terminology so that the audience can understand it though. Like,
can you how does the structure of DSG work? For example, you have an unaddressed associate. Is it a formal structure like any other VCs?
We are a very flat organization, and we were just talking before the session that, I'd like to call ourselves very AI first also. We only have 5 people in India and a lot of AI agents helping us at the work, etc. So it's pretty flat. Everyone in the investment team reports into me, and that we have 2 people. There's one person who's our AI champion. All he does is every 2 weeks, his KRA is to come up with a use case that we can use at the fund or we can get our portfolio companies to use. Now, I want to make it every week after Claude Go work. But, there's an AI champion and I have another portfolio head. She's like ex-BCG Godrej. She works with the portfolio on hiring and brand. But that's pretty much 7 of us.
Got it.
So, it's a very light organization. So, you can reach out and you will catch Hari sometime. Probably do.
No, absolutely. We all are very easily accessible.
Yeah, great. So one major terminology I want to demystify today, I really want to talk about this. The term called early stage. This term, I think it's easily thrown off. Everyone is either early stage or idea stage or stage stage. We don't know. I think everyone have our own assumptions of what does DSG mean by when a company is early stage? Can really define it.
Well, what we mean by that is no stage is early. In fact, most of our biggest outcomes have been companies where we partnered 3-product. Like if you take Veeba in sauces, which is like a household name, we wrote the business plan with Viraj, who's the founder. More recently, Super Dales, which is the largest vertical platform for pets. That was again pre-product. So that is how early we recently incubated a cat food brand. As you would have guessed by now, we're very big on pets as a category. We think there will be a lot of brands that thrive in this category. And yeah, so anything from pre-product to up to say 100 crores of revenues, that's like the zone we normally invest in. More often than not, closer to the earlier end of the spectrum.
Isn't that range very large? I mean, I'm just asking honestly. Like when you say early stage and then you say your range is where, okay,
Let me correct that. That's very fair. So that is because from Fund 4 onwards, we have an allocation for growth stage. So closer to 100 crores is growth stage investing for us. Early stage for us is typically pre-product to maybe 1-2 crores a month. Usually it's pre-product market fit. That's like the stage because always early.
This is the exact problem that founders are facing, because someone comes to us which says, I'm making 2 crores of revenue, and then we try to raise the money. No, get to 50 lakhs MRR. Now that's the next milestone. When you get to 50 lakhs, now the industry is changing. Get to 1 crore, it's already $1 million. Then you will come. That's when you did PMF. Right. But no, it's a rolling benchmark, right? Someone's constantly changing it, BC to VC, or at least industry to industry. So if we can cap early stage, let's say pre-product to let's say 5 to 6 crores of, at least annual revenue, would that be a good number for founders to say, okay, now it crossed early, or I have some PMF? What is that can be, tell the founder, say, okay, now you can ditch me. And so even if they want to go introduce themselves, we're early stage, what do we lead by that really? Essentially, is it their pre-product, or we have some customers, or we're actually doing 20-30 lakhs a month and we're on track to do 1 crore? Where do we, put this as a spectrum?
No, I think, first thing that I would say is when a VC firm says get to a certain scale and then you become interesting, it's usually their way of politely saying no. Unfortunately, in India, we still have the culture of not being direct in feedback. So I would discount that completely.
Okay.
Got it. Usually, I know most of my peers, including the tech VCs, they invest pre-product as well. It's just a matter of conviction and whether they want to do it or not.
Okay.
So my suggestion would be, the good news is now there's a lot of material on each of the VC firms. Right? So please spend some time, and maybe I would urge you to start using the AI tools, use notebook LLM, summarize their interviews and understand what have they said in terms of where they invest, when they invest, etc. And then who to go after. Like today, what I would want to leave you with respect to DSG CP is no stage is early, right? If you're building in consumer, we are open to conversation. And then we'll tell you, maybe, there might be categories where we don't have as much high conviction. So there we may need additional proof point, like say revenues or marketing efficiency, etc. But in categories where we have super high conviction, like a Supertails, Veeba, we can go like super early, right? Okay. So it's hard to come up with a framework because the underlying factor is just conviction. If you think you can convince an investor knowing what you know about the investor, you should just have the conversation immediately. Don't wait for any milestones, etc.
Got it. That's nice. I mean, if a VC is really backing on conviction as their core reason to invest, then it's very the flow of the conversation is very easy, but the rest becomes challenging, especially because at this stage, consumer brands, the market is required to actually get to the initial, revenue. It's a heavy capex, and most founders don't have that access to capital. So when you go pre-product, of course, you're saying conviction on the idea itself, but is there a founder credibility that supports that, or does it not matter? I'm a first-time founder, but I really believed in this.
No, for us, more than I don't think we don't assign weightages to our investment criterion, but more than 50% of the work we do is on the founder. Because if we back the right founder, they'll make magic happen. More often than not, the final business is not what the initial business idea that we back. But that said, I meet 2-3 really smart people every single day, and 90% of my job is saying no. That is something I've gotten used to. Okay. But at a very high level, the two things that I personally look for in founders is The first thing is the underlying motivation to start the business. And there I'm trying to understand whether it is just to make money. And if that is the case, we generally, avoid, because in our experience, someone who is just pursuing it for money or for opportunistic reasons, they tend to fold at the first sign of distress, right? So we're looking for some very strong motivation. It could either be a personal pain point, it could be a cause that they care about really, really deeply, and then you can gauge in the conversation. So that underlying motivation is very, very important. So that's like the first factor. It has to be beyond money and something very, very core. I always say this, it has to be their life's work. You have to see if you can assess that in the conversation. The second factor that we look at is, as I said, we meet a lot of smart people, but that won't cut it. We are looking for what is that one unfair advantage that this founder has in the particular startup, the context that they are operating in. Like if I take Supertails as an example, so these are founders that used to be at Licious before this. One of them was a co-founder, the other one was a CFO. Licious is the meat brand, one of the largest meat players in the country. They were there when Licious really was ramping up, in an exponential trajectory during COVID. And despite COVID, they managed the operations, ran really slick operations. So we knew that this team had it in them to really execute, especially skill sets that one needs in vertical marketplaces. We knew that this team had it in them, and that was their unfair advantage.
That was their unfair,
right? And if I were to talk about the motivation there, I knew that all of them had very large ESOPs in Licious, right? And they were willing to forego that to start up. They wanted to do something together. So that they have that chip on the shoulder and their opportunity cost and just that drive to create something new.
Yeah.
So that's how I am always looking at founders. What's the unfair advantage? What is the motivation? And that's the big part of why as is found.
I think that's very, very useful. I mean, for founders here, they should basically understand, are you ready to bet it all? Like, it's not just like a journey where you make $100 million 7 years later and that's my motivation. Most probably you won't make it if you think like that. So there needs to be a powerful why.
Correct.
I guess.
Correct.
Yeah.
Yeah.
So, this is a fun question, but between big market, great product, great marketing, or great founder, which will you compromise on if you have to, invest in it? Like,
no, first thing is, as a fund, we don't care about TAM. We really don't care about TAM. What we care about, and again, big qualification, this applies only for us. I know so many other funds that need a proper TAM slide, because when we invested in Epigamia, Greek yogurt market was zero. They literally created that category, right? Even Supertails, pets back then was a super niche category. Had we obsessed about TAM, etc., we would have never invested in Supertail. So TAM, we don't care about. So what do we care about is whether the product, the business you're building plays on long-term themes, right? Long-term themes could be just conversion from unorganized to organized segment. We do a lot of packaged food. So healthy living is a very big theme. We're investors in Go Zero, for example, which is a zero sugar ice cream. Yeah. Again, back then when we invested, the market was hardly anything, but that brand has already passed the 100 crore mark within 3 years, etc. So damn, I don't care about. What were the other factors?
Great product, great marketing, like they have a great GTM and great founder team.
I think founder team trumps everything else. And as I said, as long as you're playing on themes that have long-term tailwinds, if you are playing on themes that are not long-term, then, we may not be the best investor.
Got it.
Yeah.
So, if a startup founder comes to you and, they're trying to tell you an idea, like their idea, what makes Hari like an idea, like the initial moment? Is it transformational ideas, or is it like they you had an insight in an existing problem. What is that one thing? Hey, this is really interesting. Personally, I'm asked.
Personally, I think, the advantage of consumer investing is you can assess the idea as a consumer.
Yeah.
So for me, if it solves a personal pain point, I get most excited. Most recently, we invested in this brand called Secret Alchemist. The actress Samantha is a co-founder. That is a product that served a personal pain point. 3 years back, I met this Italian gentleman who had spent 30 years in fragrances, and he advised me to stop using any perfume. Like in perfumes, if you look at the bottle, they don't have to disclose ingredients. It's just funny. And some of the, biggest brands in perfumes don't have kosher ingredients. So he was like, unless a perfume discloses its ingredients, you're better off not wearing perfume, right? And since then, every perfume founder that I've met, I've just been asking them about their ingredients, what do you put in it, etc. And finally, we met the Secret Alchemist team who were building India's first clean perfume brand, fully disclosing their ingredients. And, it's kosher, has all the certifications. In fact, Samantha has a health issue that I think you would know. So she could only use this perfume, right? So yeah, it's as simple as that. So something solves a personal pain point, then I'm very, very excited. Or if there's something that impacts the society positively, that's another aspect that I get excited about. But yeah.
Wait, that's a very interesting insight, actually. Great. Thank you.
No, but that is a theme that we are very, very bullish on, which is like the shift towards clean ingredients, transparency. You saw that play out in beauty and personal care with all this sulfate-free, paraben-free and personal care products. Now we are seeing it in food, this away from sugar. I always say this, that for the next generation, sugar is as bad as cigarette was for our generation. And if you look at the back of pack, not just in sweets, but even in like sauces, etc., and the sugar content in it, every single category of those can be disrupted, right? So that's like another theme we are very.
I was talking to a friend as to saying, can you build a tomato sauce brand? Because the tomato sauce that you have right now is known. There's what tomato in it. I mean, it's very less concentrate and it's purely sugar. Can you do something interesting? What is the current pain point that Hari is experiencing that you can throw out today, so that probably 3 months later I can get a founder to come to you?
That's a tough one.
Yeah, just something, because, I asked you, right?
Yeah, I'm trying to think.
And giving a free access for someone to actually...
Right. I'll have to think, yeah.
Because I actually think a lot of VCs take a personal call on their investments. I think because they also end up becoming advocates and champions. Because when I start talking to certain VC ecosystem, the true VCs love their founders and their products. They're like, you have to try this.
No, I think I have my answer. A few months back, I quit sugar. So anything that's sugar-free, especially Indian sweets, that is a big, big opportunity. The key is the taste has to be as good as, the best sweet brand you can think of. Because usually healthier alternatives are not as tasty as the indulgent ones. But sugar-free sweets is something I'm really...
You have a sweet roll, huh?
Yeah.
Yeah, even I will invest if someone cracks that.
But that is a big opportunity. India is the diabetes capital of the world.
I think DSG will have an open conversation.
Absolutely. That is something,
Yeah, great. So, I think I want to move it to how you evaluate founders and product. And I want to get into that, and then we go into your portfolio a little more, because we've spoken about DSG now. So, when you meet founders for the first time, what are like 3 signals that say this guy is good, or 3 red flags that say at a founder level, not at a product level? What are those things that you see as it says this works or this doesn't work?
I think I covered what I looked for in founders. I'm generally looking at, whether the person is being authentic, genuine. Sometimes people tend to oversell or not be themselves. So just being yourself is an important criterion. And the other thing is, early stage, every investment is like a marriage, because when we invest, we assume we'll be invested for 10 years. So you have to like that person. If you don't, then in the worst times when they call you late at night, etc., you should be willing to pick up the phone and talk to them, so that, that just chemistry or that just connection at the human level, it's a bit subjective. That is very, very important as well. And I think the third one is just, very, like a strong why. That is something that I still gauge, and it's important that you do a bit of that introspection, maybe brainstorm with a chat GPT, etc., to figure out your why. And, I know it's, it may be easier said than done, but really knowing what is that intrinsic drive that's making you do what you want to, and being clear about that, that is like the most inspiring thing for me. If I'm able to see that this person genuinely is passionate about what they are pitching, then, it just excites me.
So what's your motivation? What's your why? And an unfair advantage, and don't oversell. I guess these are probably 3 things you could say on some of it. Yeah, it's a good, yeah. So in terms of product, and one more thing if I may add is just being self-aware. Do not say that you know everything, you can do yourself. So if someone is self-aware, that again is a big plus. And being vulnerable as well. Just saying what you know, what you don't. That is another thing, because typically founders feel pressurized to have a show that they know everything, they can do it all, etc. But if you just tell me, look, I'm a product guy, I just don't understand numbers, you can bring someone who knows numbers with you for that. That is absolutely fine, because it's almost mutually exclusive. Someone who's very strong in product and brand hates numbers, right? So it's absolutely fine. And we are solving for like spikes with self-awareness, so. Yeah. That's very, very well said. Self-aware equals saying, I don't know. That's basically, it's okay to say, I don't know it. So, to product and market, I want to ask some particular questions. At a early stage or seed stage, I already asked this, but how much traction is enough? Like, if you have to see, like, there's a place where you're not pre-product, you don't understand the space, but it's interesting. Where is a number that you can say we're comfortable with this traction?
As I said, we don't look at overall numbers, because it doesn't matter in my view. What we look for is signs of product market fit. And there are 2 broad ways we assess product market fit in consumer. The first thing is on just the consumer love aspect. Is this a brand, a product that consumers already love, right? And that is something that one can measure through, it can be like the Amazon ratings, etc. But we have this, NPS is a bit of a lagging indicator. Okay. But there's this test called the Sean Ellis test. Sean Ellis. Yeah, it was popularized by the superhuman founder.
Okay.
It's a simple test. It just is one question where you ask the customers as to how disappointed they'll be if your company shuts down, if your brand shuts down, right? And then there are 3 answers: don't care, disappointed, very disappointed. And there is a threshold for what percentage say very disappointed. Okay. I think it's 60%. If you're past that threshold, then, it means that you have that customer love. They will be crazily disappointed if you don't exist. And, that's a lead indicator for customer love. But important thing is just stay close to your customers, and we're looking for whether you're checking the box on the customer love angle. The second thing in consumer, when it comes to PMF, is unit economics. As I said, in consumer, you start off with positive GMs on day 1. Yeah. So we're trying to assess whether you are able to make money by selling whatever you're selling, right? Ideally in the first order, but if it's a high frequency purchase category, then maybe by the 2nd or 3rd month, not longer than that. Only then, will you be capital efficient, right? I don't know if we are covering capital efficiency. Then So these are the two things. But going back to customer love, the other biggest metric in customer love is retention, whether people are coming back and buying your product. It's hard to measure that in consumer because you don't get the data when you're in marketplaces, etc. But do your best to be on top of that metric. We know that, through your account managers in an Amazon or QCom, brands are able to get your data versus your competition. So I would just say focus on customer retention, customer love, and getting your unit economics right. If you have these two, then you achieve product market, and then only after then should you even think about revenue growth, raising more capital, etc. Right? So that's how we think about it.
Great answer. Thank you. But actually, and the next question was, is revenue more important than retention? But you pretty much answered that. Speaking of, but just to add a side question on that, when you speak about customer love and the Chanelist test, it makes a lot of sense. And I think I'm just thinking, okay, all the brands, what a brand that I will miss it, they shut down, and I have like 2-3 answers already. But let's take like a retail brand, for example, Now, it's probably a little easier to do the Chanelist test at one store. And this is my view on it. But what if there are other variables, like, for example, location that actually defines a bit? Because if you're in a dead zone and you have a retail location, then there's unbelievable customer love. But if you want to really scale, because you are building a large business, then is there a threshold to say, like, okay, do the customer love test at 5 stores or at 3 stores? Only then it's actually, because it's too small data, you will make a customer love test. And I'm asking a question of, at what scale can we say, okay, BMF is achieved? And in the retail segment, I'm asking.
Yeah. No, I think there is no downside measuring and maximizing customer love every step along the way. So I think you should definitely do it at your first store, second store, etc. So I'm trying to think in retail.
Does Sleepy Owl have stores?
Sleepy Owl doesn't have stores.
Wait, anyone else in your...
There are many, there's Kanya, which is a medical scrubs brand. There's Ugao in gardening. Yeah. They all have stores. But, there again, we measure it at every store level, right? But I think if your first store is off to a good start with great customer love, you are able to get to, say, 15-20% store level EBITDA margin. But in retail, again, you have to give a store at least a year because, there are seasonality, cyclicalities, all of that. Only then can you know. But typical recommendation that I give for people running retail stores is don't open a lot of stores too soon. In my view, in the first year, maybe maximum 4 stores and see how those 4 perform over 12 months. Before doubling down. I think you need at least 2-3 years to figure out how the store operation looks like, optimizing the playbook before opening a lot more stores.
Okay.
So I'd ideally recommend starting at your home base itself. If you're sitting in Chennai, no point opening it in a Bombay because it needs that oversight.
Yeah.
So that's sort of how I would.
3-4 stores roughly, just to get them
in a year, and then allow them to ramp up and see if they're hitting the profitability targets.
Got it. Thank you. The next question is about capital efficiency. I think we also wanted to touch about it. You can, I'm sure many of us don't know what capital efficiency itself. So just go ahead and explain what it is and what's your thoughts on that directly.
Sure. So capital efficiency, is a metric that's very close to me. It's almost like my brainchild. The first time, I sort of conceptualized it was when I was at Peepul Capital. Because at Peepul, we were a buyout fund. And, literally when we invested in companies, we were the only source of capital for the company till we got a good exit from the company. So which meant, I had to be very clear about the capital requirements of the company in the entire journey. At DSG CP, I don't have that constraint because I can bring other investors on board. Whereas at Peepul, I had to fund it myself, right? So that was when I started, more often than not, a lot of our companies, even if they hit P&L metrics, they'll always like overshoot cash burn by a big margin. So I started analyzing companies to understand how one can, be better at forecasting cash requirements, right? And then essentially it was like a derivative of this return on capital employed metric that public market investors use. So this capital efficiency was our derivation of that for the early stage, because in the early stage, companies do not have profitability. So the way we compute it is, if you do 10 crores this year and you have used 5 crores from inception to the current year, then the capital efficiency is 2x. So you've done 10 crores this year, whereas the capital is from inception to current date, right? And so we've analyzed all the brands in the last 15 years with Bain. The good threshold for a consumer brand is a 1.5x. The best brands in our portfolio are above 3x. So if they take $1 million from us, they are able to add 3 million to their top line. So, the interesting thing with capital efficiency, it eliminates the time dimension out of the equation. So when I invest, I'm not telling you should get to $4 million next year. All I tell my brands is, if you've taken 1 million, the best brands get to 4 million. We don't care if you get there in year 2, year 3, year 4, but you have to get there with just that 1 million.
Got it.
Right? That's a very different lens, but it helps in that initial phase. I said that 0 to 100 crores takes 6 years. So if you optimize on the capital dimension and not on the time dimension, you generally lay the foundations well and you set yourself up for compounding. So I'd encourage you to apply that lens on your fundraise plans. And, I would say 3x is best in class, but at least aim for a 2x so that you land in that 1.5x mark.
Yeah.
Actually, this is something you've written about also, right? Yeah, I read about this, and I think it's a very good metric, and especially the fact that you're taking time out of the equation. Because at the end of it, how much capital do you deploy and how much can you make from that capital is actually a better metric than saying in 4 years, make 100 billion,
Yeah, as I said, in consumer, you don't have to be in a rush. And I told you the example of consumer exits. Those founders had 60% stake because they were capital efficient. No, they didn't have to raise a lot of rounds and dilute themselves like the tech founders. So yeah, it's a very different way to look at it. But I think it eliminates the time dimension. It eliminates a lot of risk also. Yeah.
What is DSG's check size? Just if
in the early stages, like if it's pre-PMF, it's a couple of $1 million anywhere. There's no lower limit.
Okay.
But the stage after that, if it's a growth stage check, we can go up to 4-5 million.
Okay.
But we typically lead subsequent rounds as well, as long as the founder executes. The reason also is, like, our philosophy, our style of investing is very unique in the market. So we found that more often than not, we are the ones that have to lead subsequent rounds because the other VCs have their compulsions, etc. So in all our best performing companies, we continue leading. We can lead up to 2-3 rounds after our initial check.
Got it.
So in all, we can write up to 7-8 million in a single company, but over 2-3 rounds.
2-3 rounds.
We always tell our founders that they are free to go discover the price in the market. But, that's like, it's just a transparent conversation. We tell them what we are comfortable at. And if they don't like the valuation, they want to discover the price outside, they're free to do that. Yeah. But we've not faced that challenge yet because, we think we are quite fair at. Yeah. And as I said, the relationship is the other aspect. The relationships we share are like the best part of what we do.
Do you price the valuation of the company, the EV, on the current market, conditions, or for the potential that it may become? Because sometimes when it's pre-product, you really can't value a startup at that stage, right? So how do you then afford a valuation?
I told you the capital efficiency. So if there's a business at pre-product, I'm putting in at that stage not more than 1 million typically. I know that in the best case, the founder can take it to a 3 million revenue, which is at 3x mark. Or if I take a base case, say 1.5 million, then on average, depending on category and consumer, that 1.5 million revenue business would be priced at say 4 to 6x. So that will be $6 to $10 million.
Yeah.
That will be the value at which they raise the next round. And I solve for at least a 2-3x markup on the next round. So I just back work and tell them what the pre-money should be of this round. Okay. It's as simple. We have an open conversation and tell them this is the math. And yeah, this is how we do it. So let's take round numbers. So if it is like 3 product and I'm investing 1 million, then my expectation is a good founder should be able to take the business to 1.5 million with that capital. And if we take a 4x multiple after you have achieved 1.5 million, that means it'll be valued at 6 million when they raise next to, right? And as a fund, I'm solving for at least a 2-3x return when you raise next. So which means when you raise at 6 million, my first check should have earned me a 3x, which means my first round's post money will be 2 million, right? So that's just an example. Obviously, we won't dilute 33%, etc. But that is how we think about it. So you're better off raising a smaller quantum, say 500K, and that's the math. So yeah, hopefully that timeline. No timeline. That's what I'm saying. In consumer, we take timeline out of the equation. It's all about capital efficiency. But again, we can't wait forever. But typically, our companies raise every 2 years. The capital that we encourage our founders to raise is for 2 years. So that you get at least 18 months of execution because fundraise takes away a lot of founders' bandwidth. So we are solving for at least 18 months of like execution where you're not under pressure to be talking to investors, especially founders from Chennai, I'm sure hate fundraising. It's just such a draining process. So it's important that you have like as much time for just execution, right? So at least solve for 2 years of runway, ideally more.
Got it. So another question I had was, you look at a moat for consumer brands. Is that a core need for a startup in consumer space?
No, I think I'm not a believer in moat being a static concept. Because finally, I tend to wear a people lens in everything. And it's important that you're always learning, always innovative and being dynamic, right? So in consumer businesses, really, if one has to force with the concept of moats, the brand is the biggest moat. And that's the reason I can't emphasize enough about the importance of customer love and getting to that place where a Sula is, an Epigamia is, etc. So brand is very, very critical. The second thing is, an obvious moat, and which as a fund we really like is backward integration. Setting up your own factories, product capabilities. It does mean that the initial gestation is longer. But if you look at almost all our big wins in food, Sula, Veeba, Epigamia, Farmly, more recently, Bombay Butter, etc. All of them have their own manufacturing. And, just having that in-house and having those product capabilities in-house has served us well in the long run. Beauty and personal care has a lot of contract manufacturers, but even there, I would say, having your own manufacturing still would be a very, very big edge, especially in the age of AI. I think if you're able to control all the aspects from the consumer end to manufacturing and do it real time, it's going to unlock magic. Just real time optimization of purchases, etc., based on what you're seeing at the customer end. So I genuinely think that brands with manufacturing will have an unfair edge in the AI world.
Yeah, I'm a believer of that too. But would you recommend that to do on day one, backward integration? There are some people who come and say, you know what, I want to take over this entire space and it will not function without backward integration. I need my facility and I will hit the market slowly. Of course, there's a cash fund to support the manufacturing and put up the capex. But is that something do you recommend on day one?
It depends, it's case by case. If as a founder, you have super high conviction on the product and the pricing, I think it's still worth doing it. But there are ways to hedge it. As he said, the important thing in manufacturing is ensuring that bleeding too much. So if you have customers that can absorb your overhead, still your core brand ramps up, that's an easy way to hedge it. But it just comes down to your conviction on the product. Like Veeba started it on day one.
On day one, yeah.
So
Yeah. But I think their strategy was that we will set it up and go get one large client. And I think they cracked Domino's, if I'm right.
Correct. So it initially started as a B2B business. B2C, I must say. And they learned on the back of Domino's, etc. before they launched
their consumer brand. I think but it takes a long time to crack Domino's, but when you get it, it's like $100,000 or something like that. But that's great. Maybe before moving to your portfolio, and I want to spend some time on it. One last thing that I have a personal question on is this concept that we use called ICP, which is Ideal Customer Profile, which is something that is thrown in the tech world because we got to really target and find out who that persona of a customer is to optimize marketing. Now in consumers, finding ICP is challenging. I don't know how efficient are we in finding that. Is that something that you look in startups, or are you happy with TG like a target group? What is the metric that you think consumer brands should use in identifying customers for themselves?
Yeah, and consumer, it is not, it's not as straightforward. But that said, we encourage our founders to, be on customer calls and do at least 100 customer calls every week, be as close to the consumer. And even our team, like the person who heads portfolio, she does regular consumer research activities for all our brands because it's every founder thinks their product is the best out there, but it's important to come at it from an outside in lens, with customer feedback, etc. So I'd say it's not as scientific as in the tech world, but it's important to be close to the consumer and understand which we like. We don't like the typical social demographic segmentation. We like interest-based segmentation. Based on consumers' interests, which is the interest segment that's showing most affiliation, who are the power users, etc. But again, as I said, it's a lot more fuzzy than it is.
Than it is.
Yeah.
Because this is something that we try to instill. And I mean the larger theory is be as close to your customer, whether whatever tools you may use. But can you explain that with an example? Because between ICP and TG, there's a little bit of a tug of war going on. Like Veeba, for example, when they came in, who do you think their target group was? Like, what's the TG or what's the ICP, whichever word we want to use?
Sure. Like Veeba, when it started, as we said, it started with the Horeca business, selling to Domino's, other hotels, etc. But if you look at his initial products, he didn't go after ketchups because, the incumbent was like a monopoly in ketchups. Correct. So the first products he launched were actually like a mayo, a Southwest Chipotle. So these were products that were not there in the market. Again, going back to what we spoke, had we thought about TAM, etc., it would have been a zero. So that was the time when, Subway was getting traction in India. Indians were discovering these sauces. And now suddenly there was this brand that allowed you to use those sauces in your cooking at home, right? So that is how they started. So it will be people, who discovered those sauces and wanted to try newer cuisines at home. That was the initial TG and they built from that. But, I was thinking about your ICP question. The way we think about it normally is, pre-online, because we've been investing for 15 years. D2C was not even a term when we started. The metric we used to give brands was start in one city, in the offline channel and do nothing else till you hit 1 crore a month in just that one city, right? Profitably with solid customer love, good store throughput, etc. Only then do you know that you have a real business, and then it's an extrapolation game. You can take it to other cities, etc. Even today, we encourage that, like in a QCom actually is very similar to offline. It's a micro market by micro market game. So start in fewer cities, and we encourage our brands to monitor market share. That's like the one metric. We don't care so much about top line, but we care about market share. Like in their category, in their relevant geographies, you have to have salient market share. Only then do you have a right to build a business, etc. Otherwise, you're like one of 10 brands, and and if you spread yourself thin, the pulls and pushes will just distract you. But that's how we
That's how you look at it. But following up on this, if Veeba was taking that as their TG, but in today's online era, right, it's very hard to have such a broad target group because the cost of acquiring this customer becomes very, very expensive. You don't narrow it down, right? So initially, to build traction, the closer you know who's going to be that core person who's going, basically you need your love customers at the end of the day, and you're really targeting that because they compound and say, hey, try this, try that. That's how it's going to go. So wouldn't you say it's better to really narrow down and understand who's going to be my first 100 love customers and then take it forward?
No, at that stage, yeah. Like for instance, in in the cat food brand that we just elevated. No, this is Milo. Sorry, it just came on Shark Tank. Super Tales is like a 5-year-old investor.
Okay.
They initially started off with WhatsApp groups. They were just selling in Gurgaon and got their first 100, 200 customers, built a WhatsApp community before they launched, right? So the first 12, 18 months was no meta spending, nothing. It was either offline activations, and that's like in consumer, that's the best way to have consumer interactions firsthand, being in, like it can be in RWAs, other events, etc. And like WhatsApp is an example of a channel. Okay. But yeah, you're right. You have to start with these channels before even thinking about like spending on meta, etc. It has to be organic, and those 100 customers should come back and buy your product.
Exactly. Because the constant, feedback that we get from, I don't want to say D2C brands, but at least consumer brands is, Aravind, like we've proven it, we're doing like 5 to 10 lakhs a month, and to grow, we need like 50 lakhs of meta ad spend. Otherwise, this will not grow. And like, what's your repeat rate? And like, no, we're not hit our consumers here, they're in the other segment. And this is like a catch-22 problem. You put money and review customers. And we always believe for a consumer brand, repeat rate should be like 50%. They should really love you. Otherwise, there's not a really essential need for the product itself. So I'm glad that you have the same philosophies. So for people who are building meta ads, is not the way you grow your.
No, that's like a drug. So it's important. You can't live without it, but it's important to be focusing on organic channels to acquire customers along with added meta.
Okay, so
and the other piece, unless we are covering, is there's always a big arbitrage in figuring out the next frontier when it comes to customer acquisition. And the next frontier, without a doubt, is AI, AEO. Like personally, I've stopped discovering brands on Meta or Google. It's like, just the experience with a chat GPT is 10x better than a Meta or Google. So the brands of tomorrow that'll scale capital efficiently and that'll dominate are brands that master brand building for the AI agents, inspiring the trust of AI agents, and showing up in their results. One activity that I'd encourage all the founders here to try out is just go to ChatGPT and ask it for the best brand in your category, in your geography, and see if your brand shows up. If it doesn't, you just have to ask it what you should do and you'll be fine. So, that is the next frontier. So please, there's a big arbitrage there. Whoever, and that's something that we are working very actively.
Yeah. So it's called generative engine optimization. I think that's the term. So basically, we are mentoring one company in that space, but ideally, what was SEO for the last 15 years is basically what GE was going to do.
And, just so you know, one of the things that we've learned is Reddit plays a massive role in GEO. So please factor that in your plans. And it's ideal if founders themselves moderate on Reddit and get going on that, right? So yeah.
Actually, this is a nice thing that you touched. We were, I think, between our portfolio companies, we were discussing why is Reddit so famous? Like, I mean, maybe it's not seen on like the end consumer. There's a lot of talk that happens on Reddit, and people actually take that clear into validation. Like they take it to heart. I think it's because the world of internet is filled with reviews, and they're so generic in nature. We don't even know if the company is putting them or it's it's generated or something like that. But Reddit, there are truly honest answers, and in fact, I mean, there's a lot of hate on it also, but you can actually see an insight that's happening that now people are ready to spend half an hour and read a Reddit post to actually understand which is good and which is bad. And the whole point of the internet was to actually reduce that time so that you can get reviews and then say, okay, this is a good product, let me go try it. But now, since it's filled out, they're taking the pain of going to a Reddit website or build the download the Reddit app.
The reason that Reddit ranks very highly in the AI algorithms also is for what you mentioned, that it's the most credible review site online right now, and that's the reason it's important that and it's a channel that most founders, including our own portfolio, didn't care about till AI showed up. We're pushing them to like really get started on that.
Yeah, it was yesterday. Me and one of my founders, we were talking like the credibility of reviews itself is entirely gone. So it's basically a proxy now that we're using to actually have value on whether we have to buy or not. But I think Reddit has replaced that. We were talking, is there something to beat Reddit now? What can be that person? What can be that product? But anyways, moving on to another session is I want to spend time with your portfolios. I have like just 3 questions. And I want you to answer it for 3 of the brands that I would probably mention. You're welcome to tell which are okay. So I want to take Epigamia, Veeba, Chai Point, and Oyo. I think Oyo is also an investment. You've exited.
Yeah, Oyo was invested and exited before I joined. I'll try and answer it.
But Sula, you were a partner?
No, Sula was again invested and exited, joined, but that's fine.
Okay, so I want to take time in these 3 brands. Only 3 questions. When you came in, which is what time, what you saw, why you got convinced. These are the 3 things. And lastly, how far off were they from what they actually promised you? Like, did they hit the numbers? Or what did they learn so far they could grow to who they are right now? Across these, we can go one by one. We can start with Epigamia.
So the question was when you came in?
Like what time? Yeah, what you saw in when the product, and what convinced you to say this is the brand that I want to invest in this space.
So Veeba, Veeba was interesting. So the founder comes from the fun food family. Fun food used to be in the same category. So his dad exited Fun Foods to Dr. Oetker's, which is an MNC in the same category. And Viraj is his son. Viraj, I think at the time when the exit happened, Deepak, who's the founder of DSG, he led that investment. So he was trying to invest in Fun Foods. But the dad was like, he was already in his 50s and he wanted to move on and do other things in life. Whereas the son was, he was more excited about the future and wanted to build it much more, so he still had that drive, hunger, etc. So as soon as the non-compete ended with Dr. Oetker's, so he had reached out to us, and again we invested pre-product because we saw the opportunity. Newer cuisines were just entering Indian kitchens, and we had the founder with the right background, product capabilities to really ride this journey, right? And this was back in December 2012.
2012.
Yeah. So that was our first investment from the DSG.
Oh, really, Veeba? Okay.
Veeba, and it will probably be one of our biggest outcomes ever. It's the company has passed the 1,000 crore mark right now, profitable, become a household name. I think Veeba was probably one of those rare stories where the company hit the budget numbers almost may not be 100%, but close, because, Viraj is a best in class operator.
Okay.
Yeah. So that is like played out exactly to plan. So which means I don't have a lot of insights for you guys, unfortunately. But yeah, it was just a solid operator, and
So it was a pure founder vet.
absolutely, yeah. It's more often than not, as I said, it's a founder bet. We may really fall in love with the idea. I can't talk about it openly, and we made those mistakes. But where the founder bet was not ripe, it doesn't matter. The idea was great, even if the product was great for that matter.
Yeah. Okay. Epigamia. Why don't can you tell me that story? And what was the one angle they told? Say this is what it is that we want to do.
No, so Epigamia, again, the founder, unfortunately, is no more. He passed away in December 2024. Rohan Mirchandani. He's an interesting story. He is an NRI, grew up in the US. He came to India, just fell in love with the country and the consumption opportunity. He initially used to run an ice cream brand called Hokey Pokey. Yeah, and we were in touch with him back then, but we were never excited about ice cream as a category. But later, this was when, I don't know how many of you are familiar with Chobani in the US. It's like the largest Greek yogurt.
Yeah,
in there.
Chobani.
Correct. So, later, Rohan kept in touch. We kept interacting with him, and Chobani, Epigamia was when he came back with the idea of Greek yogurt for the India market. As I said, TAM of 0 sounded, must have sounded strange to most people. But, the thesis there was really addressing the 4 p.m. hunger pang, right? Like all of us work, we know that 4, 5 p.m. when we are hungry, and everyone's looking for something healthy, but you invariably end up eating a samosa or whatever you get in your office. So that was the pitch. That it was at 4 p.m. hunger pang, offering a healthier snack and with protein. It has 6 grams protein, 6 around a cup. And, and that was the thesis we went after.
Okay.
And even in Epigamia, the initial traction was built on the back of Horekas. I don't know if you guys know, back in the day when they started, you found it in all the airport lounges. It will be part of the buffet in the best hotels in the country, etc. So that was the channel. And Epigamia, again, we set up the factory up front. It really high conviction, because we knew that the product had to be different from a dahi, right? So if it tasted the same, then why would anyone buy it, right? So we set up our own facility, and whoever is a consumer here will know the difference in an Epigamia product.
Yeah, because customer.
And that's a brand that again has massive customer love. And Rohan, the founder, he's probably the only founder that starts off every board meeting talking about the brand. Like first half an hour, 45 minutes will be around how they're thinking about brand, customer metrics, and how they're thinking about NPD that's aligned to the brand architecture, right? So he was very, very brand focused in his thinking, and that just shows in customer love.
Yeah.
To our earlier conversation.
Actually, now it all makes sense, because when I saw Epigamia for the first time, it was so strikingly different from Curd, and I was just so interested in trying the product. And after I tried it, I was taking it out and showing it to people. You become like addicted to it in some sense.
Yeah.
I think, what year was
on? So we invested in 2016. But Epigamia, again, Epigamia is an interesting case study, because that brand went through a tough phase, and now it is in a really solid wicket. The reason it went through a tough phase is, it's a product that needed cold chain, and it's also short expiry.
Yeah.
Right.
So they 4 or 5 days or so.
2 weeks. It used to be a lot lesser. It's like 2 weeks. So it's like, and at that time there was no QCOM. It was all offline. So we used to have returns of almost 30-40% at one point. That, so in terms of capital efficiency, etc., that brand was on a very bad place for a very long time. But we stood with them through those phases, and the real change happened for them when QCOM actually took off in the country. So fast forward to today, it's a brand that does more than 300 crores in top line, profitable and cash flow positive. But yeah, we did learn a few lessons along the way. There was also another mistake we made where we launched a milkshake. Right.
Yeah.
So that was not a product of Epigamia standard. We at that time launched it because we wanted to pursue new growth levers. But the lesson from that was again, staying true to your core. And Epigamia is a premium brand. We understand the urban audience, etc. So we are better off just focusing on our knitting, right? In QCOM, for example, we just launched a 25-gram protein shake. Now that is again, it squarely fits our TG and it's taken off beautifully. So, when he was around, I remember him distinctly telling me about how he learned from that milkshake experience, and now he's clear that from Epigamia stable, it will be only premium products, and there's enough to do just for the premium customer.
Yeah. So for those who don't know what Horeca is, it's hotels, restaurants, and cafes. That's the industry. Just to because we were mentioning it sometime in Q-commerce, quick commerce.
Correct.
Yeah. Just so that people are in the same boat. But funnily, I'm not actually saying this because you're here. But when Epigamia launched a milkshake, the first reaction I was like, why did they do this? Literally, I could feel that this is so off. Because that's how much the brand had spoken to me in terms of the packaging, the way it was premium. I would feel a little fancy and I didn't try Epigamia in the office. And I felt like, oh, they did a step down.
No, I know. Even the best founders are not immune to, such mistakes. And it's part of life. You don't have to be harsh on yourself. But
but you can feel the effect, right? So clearly in consumers, but great. But just to ask, how is the brand doing right now? It's great.
it's fantastic. It's profitable, scaling massively.
Without Rohan, they're...
So, the good thing about Rohan is he's an amazing people person. Most of his team has been there from day one. And, you can't tell that we are getting a new, CEO for the business. But, the next in line have held fort and the business has grown like amazingly well.
Great, thank you. Like, see, large changes actually happen in culture only. If you actually fix culture throughout the organization, their ability of work execution, what the founders believe in all are like packed into that one bottle of called culture. Like, for example, you don't penalize mistakes is a culture that, Kissflow follows. Now, if only founders say that to like second generation leaders, then that should get trickled down to manager levels and team leads. But if they end up penalizing, then our culture will be different from the founder, and then the customer will actually feel the heat. So it's very similar to how consumer brands also work. This is my thought about it. The next one I want to spend time is Chai Point. I think you were involved in that.
This was again
Before you, but I want to spend time here because I think Chai Point was the first brand that made the tea revolution in some sense. Like they kind of took it from unorganized to organized, and then there was a whole set of brands. I think we have a Chennai favorite Chai Kings over here. I don't know if the founders are here today. They came for the last session, but any thoughts on when you came in? Why did you think it will work, and how are they doing so far? Because I believe the market's saturated a little bit right now. I don't know if you know, but
no, I think in India, most markets are not saturated because, globally, if you look at it, and all our investors are from outside, every category is growing in India, on a relative basis. So saturation, I think, is like a very sort of macro, superficial comment some people make. So the thesis on Chai Point was, again, it was playing on the unorganized to organized team. You'll find your tea stalls in every nook and corner. But our view, category after category, is the first team is moving away from the unorganized sector to buying an organized product. And typically, the second wave is within the organized segment, you start premiumizing. You want a better quality. So any category you can think of, this theme plays out. Like more recently, investment of mine, Farmly, which is now the largest new age brand on QCOM channels, is into dry fruits and nuts. That's again a completely unorganized segment that they're organizing. Whereas examples like an Epigamia or Go Zero are playing on that premiumization, right? So with Chai Point, it was that shift from our view was these, mom and pop tea stalls will eventually get branded, and there has to be a chain around it. But that's just one part of the business. The other part was actually delivering a tea stall equivalent product with a vending machine in office. So more than half of Chai Coin's business is like, I don't know if you have Chai Point machine here. It's like your CCD machines that for coffee. Chai Point has a machine that's from bean to chai, and it brews it, and then it's almost as good. Nothing can be as good as a chai from a store, but that's the other part of the business. Now that business is like a SaaS business. Recurring revenues. Once you put the machine in corporates, you just have to refill, the bean, etc. Wow. So that was the thesis.
Oh, really? Or did they start with that?
I think I'm not sure whether it happened on day one itself, but it was always the plan.
Okay.
And we were, in general, food services has been a hard one. I know you run a restaurant. Selling food services is a difficult task, especially if you run a fine dine. So we are always looking for, something that's more scalable than that.
Product players
product players, exactly.
Yeah, okay, interesting. I think Cafe Coffee they captured, that was their go-to market, right? They really,
But that was only coffee.
That was only coffee.
We know that India is largely a chai drinking country. And so our thesis was, you have to make chai.
You do that for tea.
Instead of going down to the street for a tea, what if you get as good tea, from the machine?
From the machine. Great. And that's half their revenue right now?
Yeah, it's actually more than that.
Oh, really? They're doing really well.
They're doing fine. Yeah.
Do you feel, since Chai Point is from Bangalore, do you see there is some kind of regional domination that occurs, especially in consumer brands, and that stops them from growing down south or up north? Is there a issue with that? Like, can Chai Kings become nationally known, and can Chai Point come down to Chennai? Because I don't see a Chai Point grow very fast in Chennai.
Yeah, like for instance, Chai Point is headquartered in Bangalore, but they are pan-India. In Chennai, I have to think. I don't remember the reasons why they haven't opened so many outlets. But the short answer to your question is that's not a problem. It's just a matter of figuring out the right GTM communication that resonates with different part of the country. I think whole of India is accepting of made in India brands. There was a time when international brand meant quality, status, all of that. What has been emphatically answered is that that's no longer the case. Indians are proud to buy Indian brands, and a lot of brands have done a good job exposing the issues with multinational brands. So, as long as you're from India, I think, you will be accepted. But there are obviously nuances, in communication, etc.
Yeah. Like, I think we had Bala from Manikat, come last time, and he was saying, he took a bold statement saying that it's going to be very challenging for someone from the south, especially from Chennai, to build a pan-India consumer brand, is what it is, because we have fairly not known how to communicate with them. I disagreed, of course, because I think it's all about how you learn and, get to, like, for example, Carrot Lane,
right,
which is one of the biggest, consumer brands from Chennai. And it's now known for the biggest diamond, jeweler. So I think it's possible. It requires...
Absolutely. Even in our portfolio, Indus Valley, you might know it's a cookware brand. They are, 200 crore plus. It's the largest insurgent, healthy cookware brand. Again, playing on this theme of moving away from non-stick to cast iron, stainless steel. Very grounded founders, done exceptionally well.
They're from... in Tamil Nadu, right? They're from there in Chennai. They're in Chennai?
Oh, they're Chennai. Their office is in OMR only, right?
Oh, they're close by? Oh, nice. I brought their products, actually. I think they made the Teflon to cast iron.
So again, this healthy living as a theme, right? That's playing, I told you about personal care, food. This is the case of healthy living playing out in cookware.
Got it. So you're basically saying in any industry, the first trend that happens is unorganized to organized. And then once the organized builds in, then there's premiumization and gourmets that start kicking in.
Correct. And there are multiple levers, this healthier living, premiumization, they all are on top of that organized segment.
Yeah. What would be another one that comes after premiumization? Is there anything? do you think?
No, I think there's no limit to improve and offer better products.
Okay.
Right? So, like convenience is another thing.
Convenience.
It's like really fast lifestyles, on the go snacking. Like Farmly, for instance, the fastest growing SKU for them now is these single serve sachets with trail mixes. It's just, when you don't have time, you can just carry it with you to office and just consume. So convenience is a big theme.
Yeah, I think I've seen that habit because trail mix is a very common thing in the US. They just, like they for hiking, they just pick up so much. I'm like,
On the go SKUs are, in your categories, if relevant, will be like very, very important in the future.
great. The next brand is Go Zero.
Yep.
I love Go Zero. I've tried it. I really like it. There's another brand called Getaway also, which I like.
Right.
But I like Go Zero a little more. But can you tell me that journey?
Yeah, so Go Zero was one that I led, this is zero sugar ice cream.
Ice cream.
So we had met all the zero sugar ice cream brands before that.
And you didn't want to do ice cream, you said, right?
We didn't want to do ice cream. It's a big catch. I'll tell you.
So why was the shift?
We are open-minded and learn always. So I'll get to that as well.
Yeah.
But our thesis was, healthier living will be critical in a category like ice creams as well. But the one thing we look out for in food is it has to taste good. And I have to try the product and see myself craving for the product. That's like the litmus test. You can be like the healthiest product out there, but if I don't crave it, I know that habit forming doesn't happen. And, if anything, your audience will be super niche. So we met all the ice cream brands out there, and it was only Go Zero where I craved the product again. All right. So it's as simple as that. And going back to our framework, unfair advantage, motivation, the founder was from Apsara Ice Cream, which is like an iconic brand in Bombay for hand-churned ice creams. So he had, built that business to a 100 crore operation.
Okay.
So he clearly had an unfair advantage in terms of background. And the second is motivation. It's an interesting motivation. He's talked about it publicly, so I can share. He just felt a bit constrained in the family business setup to do what he wanted to. To give it up all completely and start Go Zero and really realize his dream, right? So again, that chip on the shoulder, that was a big change. And now, why ice cream finally? We had a precedent, we knew there was a brand called Nick Ice Cream, which had scaled up on the back of NIC.
Yeah.
On the back of Swiggy and Zomato. So we know that the cold chain, the reason we didn't do ice cream before was cold chain, capital inefficiency, and cold chain is never, the integrity is always an issue because sometimes shopkeepers off the refrigerator, all of that.
Yeah.
But food delivery changed that. And there was already a precedent in Nick riding on the back of food delivery. So that gave us the comfort to back it. And founder was a big check. Healthy living, we were sold on an opportunity. But what really, helped him take off was QCOM. Quick commerce.
Oh, really?
His emergence and the rise of QCOM were very coinciding. And to his credit, as a founder, he could have gone and opened parlors because that's what he did in Apsara. But he had the foresight to tell me that, Hari, I don't want to do any parlors. I'm seeing this QCOM channel exploding. I'll just single-mindedly focus on this channel and get to salient market share. Going back to our discussion on being salient on one aspect first, right? So today, I said it's over 100 crores. 60-70% of the revenues is just QCOM. And he will be the market leader in most geographies that he operates in the better for you ice cream category.
Got it.
Right?
But a question on that, this is my thought because I believe, especially if you're a new brand, building brand value and, building customer love, I personally think it's very hard to do it in QCOM. And I felt that you need to have your offline or at least your own presence with the customer and have conversations with them before you start scaling it in QCOM. Because I thought QCOM is a way to actually start scaling it once you know your relationship with the customer, the pricing, the product quality, the feedback. But Go Zero did it the reverse, right? So Do you see the quick commerce as a clear channel to actually build a powerful brand from day one itself?
No, absolutely. The key is, the key is that you have to continue investing in brand outside the platform also. Because at a very high level, we classify brands as pull brands and push brands.
Okay.
And you have to be a pull brand where the customer is coming looking for your brand.
Okay.
Right? Even the QCom guys, we work with all of them.
Yeah.
They have this term called cart breakers, which means if an Epigamia is not available on Instamart and you have some other items on the cart along with, or other items in your cart and you're looking for Epigamia, if Epigamia is not there, you then quit Instamart, go to Blinkit and look for Epigamia and again repopulate your cart. That is like where you should be as a brand, right? And that means you continue investing outside the platform.
Okay.
So that you're not at the mercy of the platforms on their commissions, all of that.
Yeah.
And the interesting thing with QCom is, I think that it's far better than offline when it comes to sharing data, insights, etc. Because the QCom guys will tell you what is the price band that is working for the channel, and you can factor that in your NPD as well. And the advantage we have is we work closely.
Can you explain what NPD is for them?
NPD is new product development.
New product.
So I would urge you not to think of QCom as just another channel because it has its own constraints. There is a dark store, there are volume constraints, and there are price constraints also. And you need a dedicated new product development strategy, communication strategy for that channel. You just can't copy paste what works on an Amazon on QCom and hope that it will fly. You need that dedicated attention. Like each channel needs the dedicated GTN. So depending on your category, you should figure which channel to go after. And as I said, just dominate the channel to go spreading yourself there.
But do you think the economics work in the QFarm because the high commissions as well?
Actually, right now, economics are normal good in QCom for our brands because QCom is still in the market creation phase. That's what we had Harsha with us in one of our podcasts.
Okay.
He was like very frank with our founders that it's a market creation phase and they are, at their nicest in terms of...
They're flexible with the commissions.
So it's only when it matures that they will start working on efficiencies, etc.
Okay.
But, as a young startup, it's a no-brainer to ride on this platform with such cordial commissions and, with the kind of growth rates they have. So it's almost a no-brainer.
In fact, they actually do marketing for you, right? In a large sense, because I think there was we had a conversation with with one of the quick commerce guys in China, and they were like, any guy who's going to supply me dry fruits, just put them to me. I'll give you zero commission. In fact, like a little close to that, because we don't have someone, and because of that, our shopping value is like reducing. So they are in that need to actually create all these vendors for them so that they build the ecosystem.
Yeah, and just covering the importance of focusing on a channel. When we invested, Farmly was almost 70% on Flipkart, and they were dominating that channel. But fast forward to today, the biggest channel is QCom, and as I said, they are the largest new age brand on QCom. But that's an example of a brand that dominated one channel and then rode the wave as another new channel took off. And Flipkart still continues to be important, but QCom is just outshadowed every other channel, right? So it is possible, because the usual question that I get is, being too concentrated on a channel, is it too much risk, concentration risk?
Yeah.
But my view there is, as long as you're agile, there's no downside. But, first milestone always is relevance and saliency, and that you can achieve through focus. So the fewer channels you are, fewer products you are, you can get to salient market share and then build on it.
Do you see the QCom channel sustaining in the long term though? Because that's the talk that everyone is having.
No, QCom is here to stay. No two ways about it. If for those who follow consumer company results, etc., you would know. Modern trade is seeing a bit of slowdown. The habit forming has happened. I don't think anyone is going to make the effort to go to a modern trade or even like e-commerce platforms, right? If you can get the product delivered in 10 minutes. So much so that, we work with Amazon, Flipkarts of the world. They are tailoring their business model also to, bring QCom as the priority. So the lines between QCom and eCom are blurring. So Amazon's now started off with Amazon, now Flipkart had his minutes. So all of them, for their fast moving products, want to get those to you within 10, 20 minutes if you're in a metro, within an hour, 2 hour in other cities. So that's the stack. And everyone is reorganizing their supply chain behind that. So QCom is here to stay. Consumer behavior has formed.
Yeah, in fact, I saw a startup that was doing fashion in under 20 minutes, 60 minutes or something like that. Your most favorite t-shirts in this guidance, I think it's in Bombay. So,
so we are living in a first world country.
I don't even think first world can offer this because...
No, exactly. My favorite time pass with our LPs from the US, etc., when they visit is give them a live QCom demo. And you should just see the expressions of that piece. Everything from an innerwear delivered in 10 minutes. They're like...
Yeah, I think between UPI and, QCom, we are the leaders in that kind of technology.
Like unparalleled. Nowhere else.
Yeah, truly. But it's a labor arbitrage, right? Don't you think that's the reason we're able to enable this QCom thing?
Labor arbitrage, definitely. And the other big aspect is population density also.
Okay.
These are, if you speak to these QCom founders, Adit had the best answer. We hosted him as well. And he was like labor arbitrage, population density. And third is just purchase behavior in groceries. We have very small pantries. We can't stock up. So we need that frequent purchase. So these are like the three big factors that started it. But, as I said, it's no longer about groceries. We have a mattress brand that does well in QCom. Uga, which sells plants, they did almost 60 crores this year on QCom. So it's like, when you can get something within 10 minutes, why would you wait longer, right? So
I actually got a phone in QCom.
Correct. Yeah.
It has almost the same, or if not more, in terms of population and much bigger cities, much more metro. But I think it's a labor that really...
like the other market where, it's working out beautifully outside of India is the Middle East.
Oh, really?
There the unit economics is even better because the labor costs are not very different from India, but the prices are like 3x.
They're able to pay a premium.
So the market caps of QComs there, I think, are bigger than our QComs at a fraction of the revenue.
But in fact, the whole delivery industry, for any country except India, it's a premium service.
Correct.
Like DoorDash, if you have to order in the US, it's way more expensive to buy a pizza on DoorDash than actually going and walking down and getting it from Papa John's. But here, we have deep discounted it so that we build the habit. And now we don't want to pay the premium. We're like, no, you still give me at $149, give me a 6 slice.
But, if you look at, the good news is all of them are listed now. So you can look at the unit economics, etc. The QCom unit economics are far superior to food delivery. And directionally, as I said, that's why I'm confident that it's here to stay. But I can't comment on the market cap valuation. That'll get corrected, revised upwards, downwards eventually. But there's no question about whether this is going to be around.
Yeah. I think consumer brands have fairly benefited from the QCom.
Absolutely. And we have the largest packaged food portfolio in the country. So as a fund, we are the biggest beneficiaries. So that's the reason we host all of them. We do these sessions with them every single year for our portfolio.
Got it. Great. And I think the last brand I want to touch about is Sula Vineyards. I'm so happy that we have at least one alcohol representation, from India for the world, and it's spoken about. What was the conviction for that when you came in and where they are right now?
Yeah, so this was again before my time because it was long back. Rajiv Samant, who was the founder, he used to work at Oracle in the US, so he was a software engineer.
Oh, okay.
And, he just became very passionate about wine in general in the US. And what he discovered is he's from Nasik in India. Nasik is one of the, biggest exporters of grapes and really high quality grapes.
Oh.
So his idea was if we are the ones that have the best grapes, why not
have the
create
best
wine, right? And as absurd as it sounds, like a techie wanting to create a wine brand, but was willing to go the distance, it's almost like an agriculture business because you have to grow the grapes,
produce
the wine, all of that. So again, someone extremely irrationally passionate because India still is largely a hard spirits market. Now Sula has like 60% market share in wine. Back then, wine was a tiny, tiny industry. But he was willing to do that. But that's the advantage of being a category creator, be it a Sula or an Epigamia, etc. You have the opportunity to utterly dominate that category, as it grows. Sula now has more than 50% market share. In Greek yogurt, it'll be the same for Epigamia as well. But that was a journey, starting with, establishing the vineyard in Nasik. And the interesting thing there is, as you know, in alcohol, you cannot advertise openly.
Yeah.
That is the reason Sula started the Sula Fest, which is the music festival, which was a way for them to invite people, see the vineyard, and just give them the complete experience. There's wine tasting, all of that, and the work around not being able to publish. And now the music festival has its own like a entity of its own and has a loyal following, etc. And now it's a listed company. So that's been the journey.
But do you then think for any startup that is getting into the business of category creation, they definitely require a very powerful investing backup. Like because Sula would have taken a lot of infrastructure, marketing. In fact, the hardest challenge is to educate customers, because there's a huge branding exercise in terms of learning, all of that. So do you think category creation is possible without funding or?
No, it's absolutely possible without funding, but the prerequisite is being extremely patient, because it's anybody's guess on when the market will open up.
Yeah.
Like Sula was founded 02, 03 and it listed in 22. So almost a 20 year journey, right? To give you a sense. And correct. And so, you also know we were investors in that journey. That's where our learning comes from. And we just appreciate the power of building it slowly. But I must say, Sula is slower to our liking as well.
Yeah, because...
But the fact is, we made good money. No complaints. A lot of funds made good money. But the important lesson is if you are starting off creating a category, know that it's going to be a patient game. You might be lucky, and like a Go Zero, for instance, the market, if you had asked me, Go Zero is at least 1 or 2 years ahead of what I predicted they'll be at. I had no clue that zero sugar would take on the way it has. A big part of that is QCOM as well.
Yeah.
And the fact that, QCOM is just one part, but I didn't realize that, Indian consumers will be going off sugar so quickly. The other wave that's happening, which you might know, is the protein wave.
Yeah.
It's crazy. We have seen everything from protein, atta protein, Cheque, protein in everything, right? It's almost like if you have some protein on your label, the consumer will buy it.
Protein water.
Correct. Absolutely. So yeah, if you're lucky, it may be faster, but if it's a category creation play, just know that it's a patient game. And it's not about capital. It's just about patience. There are enough bootstrap brands that have scaled up really well. But it is more patient than a normal consumer.
Yeah. Any one brand that you want to talk about in this kind of fashion that you were invested in, because, some of them you were not part of.
Right.
But something that you want to talk about.
And in Secret Alchemist case, it was a personal pain point that I got. I knew that most of the world didn't know, but it's a matter of time. I think there was this Nikhil Kamath podcast.
They spoke about fragrance and suddenly everyone started searching what's the best.
Correct. So in Secret Alchemist case, the founder of the business is Ankita Karani. She comes from an aromatherapy background. Her mom was an aromatherapist. So again, hardcore product capabilities. That's the reason she was able to crack that clean formulation. I met so many perfume founders that I said there was no one that had a clean perfume. And marrying it with Samantha, who is one of the most credible celebrities out there, and authentic about it as well. Samantha was first a customer of the brand before joining them as a co-founder. Because of her autoimmune condition, she couldn't wear normal perfume. So, and based on what we know and the work he did, her following is extremely intense and very, very credible face.
Yeah.
So she was then, that was like the big checks on the founders. And in terms of just long-term themes, we spoke about ingredient transparency, healthier living. This checks all those boxes. And fragrances is a super underpenetrated category in India. Like most people still don't wear perfumes, etc. So it's just a category for the future. And that's how we invested there off to a really fantastic start. So
Better for you is sort of like an overall like big team for us. Since we touched about Secret Alchemist, I think I was talking to you before we started. This celebrity endorsed brand, that's coming up. You have Deepika Padukone, you have Supi with Ranveer Singh, and of course Samantha with the Secret Alchemist. They're all off to a great start, and I think that's a great, good start for a startup. Who is the operator? But do you think you see that as a trend right now happening, and it's a sustainable model because you have Underneath that recently got funded, which was a great. So I think I was saying VCs are actually looking at creator-led brands as a genuine startup, business, and they're ready to invest in that. You see this as a thing that's going to carry on forward, and what are the pros and cons of celebrity-led brands?
No, I think we've been approached by a lot of celebrities because there is FOMO, given some of these brands are taken off among the celebrities. Yeah. But the way, our learnings has been that the number one thing is it has to be authentic. I spoke about the Secret Alchemist case study, but some of the other ones that have worked, like Kirti Senon with Hyphen, it has to be authentic, and people should be able to trust that the celebrity actually uses the product. Yeah. Because historically, there are top tier celebrities that have endorsed like Pan Masala, etc. Those were days and that was okay. Yeah. But I think the new age customer is a lot more aware. So it's very, very important to have a celebrity that's authentic and visible.
Yeah.
And for it to look organic. That's like number one. But the second thing is, having a really solid operator work with the celebrity. Just the celebrity cannot do much. They'll probably get the initial awareness, but it's the operator that runs the business. So those two things coming together is where magic happens.
I think the best example is like HRX, where they think HRX, Mintra paid a big role. Right. Yeah. But you can actually believe that Hrithik Roshan,
even all the global case studies, the Kardashians, brands, etc. Usually you don't know much about the operator because they are in the background, but they are as important, if not more, than the celebrity.
But I want to ask about the journey of a startup founder with a creator-led brand. For example, let's say I'm a startup founder. I don't know how it works with DSG, and I come with you and I say, I have this amazing creator, and I think it's great. I want Samantha to be a part of this. Can you get things for me? Is that something that you would entertain saying, this is a GTM that I want to go to? Like, as a founder, I come with a product and I say, the only way this works is if we get a big person on this and we can blow this up. Is that something that you're ready to entertain, or do they come with a plan? I've already spoken to a setup.
Yeah, if you, like our portfolio, we work with every celebrity you can think of, tier one, Bollywood especially. And if I look at the hit rate of the celebrity actually helping the brand, it'll probably be less than 10%, right? So it is a lottery. So what I told you was like the culmination of learnings from all those things. So the founder comes and pitches to me that a celebrity will blow this up, then that means the founder doesn't have conviction and doing it themselves. So that's a big red flag. So if anything, I would rather have the founder and celebrity meet me in that meeting. So they've convinced the celebrity and I can assess both of them. Right. So yeah, that's how I would see it.
Okay. But this is a little intricate, but are you worried about the equity proportions between the celebrity and the founder so that, because sometimes there are people who bully one another and sort of take large amounts of equity saying that, my brand is so much more larger. You are just an operator. I will take 60 or 70%, blah, blah, blah. And VC, they're going to clearly see that there's not enough skin in the game for an operator to actually execute this, right? Do you see that as a red flag, or how do you?
No, if the celebrity, like even a Secret Alchemist, Samantha has a chunky stake.
Yeah.
So we are never obsessed about like the founder share holding, etc. As I said, ultimately depends on that ultimate motivation of the founder. We feel that there is genuine passion, etc. State, etc. is secondary. So if it is the right celebrity, they should also have adequate skin in the game. It should matter to them.
Yeah, before. Sorry, Hemant. I'll get to that. Yeah.
So, they should also have adequate skin in the game for it to matter to them. If they only have like, say, a 5%, 10%, they may be making like 5x of that every year through what they do.
Yeah.
So I think there's, again, no standard formula, but we don't stress about celebrities owning a big chunk as long as, the celebrity is truly invested in building the brand out.
Sure. I think we have Divine here. Kiru is here. So, he's one of our, consumer brands from Chennai. And I think Nayantara has invested in, and Ideation has invested.
I've heard of it.
Yeah. Is there this idea of conflict in terms of investing in brands in the same category? Do you look at it like that?
No, so we, given we are a sector-focused investor, invariably there will be overlaps in some of our brands. What we avoid is two brands taking each other head-on, which means same positioning, same price point, etc. Okay. But otherwise, usually even before we invest, we let the founder know that we have a competing brand. Are you okay with it? And if they're okay, we have no issues.
You don't see that?
Yeah.
Does that stem from the fact that you believe India is, underpenetrated in all levels of?
No, as I said, we are just scratching the surface. Every category our businesses operates in, if I take a developed market like US, there will be 10x the number of, in terms of competitive intensity.
Okay.
So we are just starting in our journey. So much that, one of our investors is L'Oreal.
Yeah.
So they jokingly had told us that, now you have us with you, we'll give you the insights, deploy your entire fund just in beauty and personal care. Where like as India goes from 2,300 per capita income to 4,000, the spends on beauty and personal care will be exponential.
Okay.
And they had like 10 markets where they've tracked this trend, right? So sometimes we don't realize it because we live in this country, but when you talk to these people in the developed markets who've seen it, you get the macro picture.
Yeah.
And that's where, if you're a consumer founder in India, it's like an amazing time to be building.
Yeah.
What was your, do you buy that advice?
No, we have other investors to take care of, and we've increased our focus on beauty and personal care, for sure.
I think they're basically trying to subcontract their innovation.
No, not really. I think it was said in with the right intention. And even in India, there's so many, including minimalist beauty and personal care brands that have done well. But we have like brainstorming sessions with them.
Of course,
and
But the larger MNCs have taken the stand that, hey, since we're the incumbent, it's hard for us to really understand what the new customers want. So let the entrepreneurs of the world.
No, that is like, when we started back in 2012, that was our thesis for DSG CP. If you look at all the consumer exits that have happened, almost 70% of them are strategic exits.
Yeah.
Where strategics buy your brand.
Yeah.
Right. So probabilistically, that, if you're looking to exit at some point, etc., that is what you're staring at.
Yeah.
And that has implications on how you build the business, etc., because it is slightly different from how you would build for an IPO. You're better off being a lot more sharply focused, because a strategic is looking at how you fit in within their portfolio. So sharpness, domination in terms of market share, a lot more important. If you straddle too many categories, the strategic may be interested in one but not the other.
Yeah.
So those are things to take care of.
In fact, I think that's why market share is more important, right?
Absolutely.
Because they're very clear. If you're dominating here, I'll just buy you out, and it's very clear. Well, no point in just growing revenues because, okay, that makes a lot more sense. Great. So I want to move to the one of the last sessions, and then I'll open it. We have a small rapid fire, and then I'll open it up for questions. But fundraising. I think that's the last section I want to start with. So before fundraising, just 2-3 questions before getting to how to invest. How do founders? You can talk to the audience. How do founders conceive consumer ideas? I want to go to the idea level itself, because you want to encourage people invest, build consumer brands. How do we conceive these? Because a lot of people say, think about pain points, think about your daily frustrations. But from a VC lens, what would that advice be?
No, I think the consumer pain point, personal pain point still is an important one. If you find one, that is great. But in consumer, the real advantage is, unlike tech, these are real world businesses, not rocket science. So one of the things that we do as a fund as well is be on top of trends, brands that are doing well in developed markets. Like, the simplest thing you can do is look at brands in the US, which are the brands that are gaining traction, which are the brands, that have scaled up well, that have raised funds, and then double click on everything from their positioning to go to market, etc. And then obviously you have to adapt it to the Indian market. Like most of our founders, they'll come into the meeting saying, we're building like the XYX of India, right? Like Epigamia, he didn't say that, but Chobani of India, or, like Whole Truth back in the day and nothing else. He was building like the Cliff Bar, etc. Yeah. So all of them have their inspirations from products that have worked
in the West, at least.
And it just helps, VCs also understand, if there are precedents, then it's just easy for us to triangulate and be more focused in how we evaluate that. So one aspect is looking at what's worked in the West and whether it's applicable to India. Like even a Go Zero, for instance, there was Halo Top, which was like a big zero sugar ice cream in the US. The third thing is, if you have the right connects with channels like a Blinkit, Zepto, Amazon, they are flush with ideas because they know what all the zero hits, what are the customers searching for, etc. So the best way is to figure a connect. And, there are a lot of people from Amazons of the world starting up, and it's amazing the data point they have. They'll be like, Hari, this particular price point, this category, there's no brand, right? And now they want to launch a brand and figure a story, etc. But these are like, at a high level, I think 3 ways in which you can, generate ideas.
Got it. I had another question, but you actually sort of answered that, which is pre-VC, do brands focus on growth or profitability? And I think you were clear that, have good unit economics. But I mean, this is a question maybe I want to ask again, simply because I only heard from DSG or from Hari right now that you're very clear about your thesis and build frugally, build slow. But let's say for a founder, anyone else is thinking about, okay, how much am I growing month on month? Am I growing at 40%, 30%? Because the VC, terminologies is, are you growing 10x every year, or are you growing like 40% month on month? So everyone's trying to optimize for that.
Yeah.
So in the offbeat, we don't get, a founder doesn't get DSG. What do they really optimize for then? Because if DSG is the only VC right now for consumer partners in India.
No, there are actually a dozen. When we started, we were the only one. The good news is there are at least a dozen consumer-focused VC firms.
Yeah.
And each of them have their own, styles of investing. So there is plenty of capital available.
Yeah. But would you still recommend founders to build in this thesis, like build frugally, build?
Yeah, big caveat is there's no one way to do anything, especially building a business. This is an approach that works for us, we deeply resonate with. But there are other consumer VCs also who are a lot more aggressive in their underwriting. Okay. So, and even no one doesn't like growth. But we don't like growth that comes at bad unit economics. There are brands like a Family, etc., that scale to 400, 500 crores just within 3 years.
Yeah.
But in a capital efficient manner.
Got it.
Right? So I would frame it as not an either or. If you can grow well while maintaining your fundamentals, then that's the best place for us.
I think it's a balance between growth and profitability. You got to mention. Okay. Now, getting to fundraise, when is the right time to raise your first institutional round? Is there a time?
As I said, there's no such thing. As long as, and I would urge you all to, research all the funds that invest in your sectors. As I said, most of them put out a lot of content. You can use the AI models to distill summaries. You don't have to go through every single one of them. And then decide whether you can convince that person knowing what you know. Worst case, you may get rejected, but you will be on their radar, and we typically track brands that we pass on as well, right? So there are founders that stay in touch, and we like that as well. Nothing like knowing a founder over a period of time before we end up investing. There are founders we've known for like 4, 5, even like Go Zero, I'm known for more than 10 years. Right?
Wow.
So I would just say no stage is early. In fact, getting exposure to VC conversations, pitches is a good thing. Just that, don't take a no to heart. As I said, 90% of what we do is saying no. And just take it constructively. And, even if the VC doesn't deliver it in the most appropriate way, just go in for the learning and, and then keep building, be in touch. The only thing is, don't try to oversell and over communicate as well. I would say cadence of maybe once a year or maximum twice a year in terms of sharing updates is more than enough. And again, keep them succinct and just highlight things, in terms of milestones you achieve, so that, our inboxes are flooded with pipeline emails, pitches. But if it's a company we met, we always know the background, etc. The question is, what has changed always? So I would suggest if something has changed dramatically, that's the right time to ping them again and highlighting it in the email and then, carrying forward with the conversation.
Got it. So with respect to DSG, I just want to ask straight, like, what should a founder and a brand have achieved to come and approach DSG? If there is something like, these are 3 things that we clearly look at. And
no, we spoke about what we look for in the founders.
Yeah.
If you have a product, then our underwriting usually is it's very simple. Someone in the investment team should see themselves as a power consumer of the product. It's as simple as that. If not, we should find someone else who's a power consumer. Otherwise, no deal goes through, right? And that's the advantage of consumer investing, because you can evaluate it as a consumer. So always we try the product, and someone has to love the product for it to progress to the next stage. And I think the third one is around this customer love and capital efficiency. We really respect founders who respect capital, and we respect founders who respect consumers' customer love. I think that's pretty much it.
Great. So I want to go into this next thing, which is this magical thing that we call pitch deck, which everyone, we all have our wonderful versions of it. Right. Some will say it has to be short. Some will say it has to be 10 pages. Some will say, no, I'm only going to give me a page note and that's more than enough. Now, what does DSG expect? Do they expect a pitch deck? And if so, what should be in it that says, okay, this is the right founder?
No, actually, for us, the pitch deck is not as important in the scheme of things, because if you have a kick-ass product, especially in food, if you come to the meeting and make us try the product, that is like more than half the job.
That is the pitch.
Yeah, that is pretty much the pitch. As I said, we don't obsess about TAM. Usually, most of our pitches are where we dig deeper on the founder journey and on the product, right? A pitch deck is always like, a secondary thing. We only look at it if we don't know the category and we need some insights, etc. It's always about the founder and the product, nothing else.
I think there's only 2 things you need to crack. Yeah. Be very good as a founder, have a very good product.
Absolutely.
I think you're done. As long as they're a power consumer, you pretty much get some money from DSG. So yeah, you answered like 7 questions in one answer, I guess. So I'm glad. So we'll talk about approaching now VCs. Like, what is the best way to approach DSG or any VC for matter? Because a lot of people try cold emails, a lot of people try, connections, and, some people, they also discount the value of an analyst or an associate in a firm. They say, no, only I'll talk to a partner. But there are some good connections to be made there. So if you could throw some light on them to startup founders to say, how do you make your network so that you can reach out to the right founders? What is the right channel?
I think all of us are like, I'm active on LinkedIn and most of my team as well. So LinkedIn works absolutely fine. And otherwise, it's always good if you find a first degree reference, a portfolio founder, or someone who knows us. That is another way. So, as long as you can send us a mail and we're all approachable. So I don't think there's any, preferred channel one over the others. And I encourage you to speak to analyst associates with respect to the designation, especially for us because we are a team of 5. So every person has a major say in the investment decisions and, has an equal voice in the table. So as long as you're speaking to someone from DSG CP, you shouldn't be worried. We're not a big organization.
But do you think warm intros are probably the best way to go?
That obviously helps. If there's a founder I trust and he says this particular founder is amazing, then that definitely
That's basically it.
More than warm intros, I said, it'll be good if someone can like vouch for you to us if we didn't know you. That obviously carries a lot of weight. It's someone we trust saying that this person is, yeah. Because even in our founder evaluation, a big part of what we do is references. There's only so much we can gauge through our interactions with someone we haven't interacted with in the past. We do extensive referencing to cross-check our hypothesis around what the strengths of the founders are, etc.
Okay. So what does a typical process look like in DSG when they invest in a startup from meeting to investing? Can you tell me the flow and the timeline it generally takes?
And usually, from the first meeting to an investment decision, we try and keep it under 4 weeks. For best case, it can be within a week, 2 weeks, where we really understand the sector and the founder blows us off our feet. But usually, it's under 4 weeks.
Okay.
We don't let anything slip beyond that.
Okay. So mostly we meet an analyst or an associate, whoever we connect with.
Whoever you connect with, and then you meet with, there are 3 partners.
Okay.
So 3 of us meet you either together or separately. And then we do an IC discussion internally, and then we make the decision.
Okay.
Yeah.
But do you do customer background checks on?
So as part of what happens in the background is we typically ask for customer data. We do at least 50 calls with consumers, understanding their experiences. On top of that, as I said, someone in the team, ideally, should be above a consumer. That goes without saying.
Yeah.
We do a lot of customer calls. We do a lot of channel checks. Good news is we only focus on a few sectors, so we know all the category managers. We understand how this brand is doing versus competition, etc. So the channel checks are table stakes. Those 2 are pretty much bulk of the work.
Yeah.
And the other piece we do, which is important, is we also speak to strategics. Because as I said, 60-70% of consumer brands end up being sold to strategics. We get a strategic lens on what you're building as well. Even before we invested in Go Zero, we'd spoken to strategics and there was clear interest that if a zero sugar ice cream brand scales up, we'll lap it up, right? And it's an important signal for us.
Is that a deal breaker?
It's not necessarily a deal breaker. It just gives us comfort because in the private markets, liquidity is the major challenge.
Yeah.
Where does one finally exit?
Yeah.
We are finally paid to collect money, not to invest money. So that is an important consideration for us. So it is not like a must-have, but we always do those checks. If strategics are not interested, then we should have a clear answer on why we want to do this despite that.
Yeah. And you write off IPOs exits, is it?
No. So IPOs is always an upside for us. Okay. It's not the base case. I think underwriting an IPO exit on the part of an investor is being intellectually lazy because you can always project big numbers, call it an IPO story and try to invest. But for us, it's more around building that rigor and muscle, right? Because in consumer, when 70% are going to be strategic exits, and if there are no strategics interested, then you should ask yourself, what are you seeing that no one else is seeing? Unlike tech, where the sector itself doesn't exist, right? In this case, You're just launching a new product, a better product, etc., in categories that everyone understands. And you know that the incumbents have a well-oiled machine to acquire.
Yeah.
So that is more around rigor at our end, so that's how.
So do you then think startup founders should keep a strategic exit in mind and build accordingly?
Once we invest the 0 to 200 crore journey, we think you're better off building the business such that it's interesting for a strategic. I think it just hedges your risk really well, because for whatever reason, no one can predict the future. Things may go wrong, etc. If for whatever reason you straddle too many categories, you just become so much uninteresting for a strategic investor.
Yeah.
Right? So that 0 to 200 crore journey is where we urge our founders to be very, very category specific, so that you are very as attractive as you can be to a strategic. It's only when you're past the 300, 400 crore mark that we even encourage our founders to think about an IPO. Then there it is more of a scale game, but more than scale, it's a profitability game. IPO investors value you on EBITDA, PAT, not even EBITDA, PAT. So these are two distinct phases. What I have seen is when a founder becomes too aggressive, too over ambitious in that 0 to 200, then you're putting yourself at risk of being in a no man's land. I know so many case studies where a brand launched into 3 categories, did a good job. All 3 categories, scaled up, say past the 100 crore mark. But then when they wanted to exit or even fundraise, a strategic said, I like that first category, but those 2, I don't care, right? Then all the effort you put into building the other 2 categories is just not, yielding the result it should. Had you spent the same time focusing in this category or maybe exiting when you dominated that category, you would probably have been better off.
It doesn't compound, basically,
Correct. You don't get the same return on effort for those things.
Yeah.
So that's why, the thumb rule, if anything I'd want to leave you with, is till you cross the 200, 300 crore brand, be as focused on one category as you can be. You're hedging yourself really well. Only after that, think about launching like newer categories, etc.
Okay, got it. And post fundraise, what is DSG's contribution to the startup after funding? Is there any kind of networking or building relationships or helping them scale? What are the activities that DSG does?
Yeah, as I said, people come to us for what we offer beyond capital. We do multiple things. Maybe I'll cover the things we do which are unique to us.
Sure. Yeah.
The first thing is, we do a lot of brand work. As I said, founders typically have a point of view that their product is the best and, have a positive bias towards what they are building. We try and bring a reality check with consumer research. So the person who heads portfolio, she does consumer research to bring that outside-in perspective on what people actually don't like about the product. Okay. So you can work on it, right? And also part of that is shaping the brand narrative, because brand is the ultimate moat value driver in a company. So we work closely with our founders on the brand architecture, even simple things like packaging. You spoke about Epigamia.
Yeah.
The packaging is distinct. Just having a distinct packaging that you can own goes a long way, right? So this brand consumer research is one bucket. The second bucket that is very unique is this focus on capital efficiency. So one thing that consumer founders normally are not on top of is balance sheet and working capital. Like in tech is a P&L business. Yeah. There's no working capital, no anything. Yeah. But in consumer, most of the capital gets stuck in what we call working capital. Inventory, receivables, creditors. So as a fund, we help our founders get better at cash flow forecasting.
Yeah.
Because if you are good as that, then this capital efficiency automatically follows, and it's not rocket science. Just ensuring you're above that 1.5, 2x mark in capital efficiency. That is something we work very closely on, and that I'd say is like our secret sauce in that 70% hit rate.
Yeah.
Right. So if something is going wrong, we just tell them, just be patient. Don't be in a rush to grow. You have 5 crores left. Let's see how we can, manage this year with 2 crores. Let's look at all the balance sheet items, cost items, consolidate, and then push hard.
Yeah.
Right. So that's pretty much it. But outside of that, one area I'm particularly focused on is AI. As I said, I have a AI person in the team. And I think the brands of the future are the ones that are AI native, not Instagram native. So you have to become AI first ASAP. And I genuinely think founders who are AI first will leapfrog all other founders. So that is something that we do. We run AI sprints every single month because the world is changing so rapidly. That's the fun part. Like what you know now becomes redundant a month later.
Yeah.
So we are doing these real-time sessions and you're welcome to join. I think we've started opening it up to public as well.
Oh, great.
Uh,
This is the context of the consumer brands
it's
using here.
correct.
Not like investing.
No. That I think investing in AI, there are funds that are experts at it. We don't understand that. It's about, but AI to me is like electricity. It's going to penetrate everyone. You can't think you're building a consumer brand. This is not relevant for me. Because personally, I've seen the difference it's made for us and in companies in our portfolio. Like the Indus Valley founder, he jokes, he says, ChatGPT runs my strategy, right? So it's like a thought partner.
Yeah, it does.
So this is context is these AI sprints are for consumer brands for use cases in AI, right? Like our next sprint will be on Claude Cowork.
Okay.
We have a few interesting use cases that the team has worked on, which we'll be sharing with our portfolio. So we do that. Apart from that, hiring and the usual things, all the other funds.
Oh, okay. So you're trying to see how can the consumer brands adopt AI into their internal systems and trying to...
Everything from being a thought partner to, as I said, being able to be discovered by AI agents, win the trust of AI agents, using it in supply chain. It's like endless. It's a long, long list.
Okay.
It's like there's no function where you can't use AI. And I'll be happy to be challenged on that.
Yeah. So let's just take one scenario. For example, let's say we invested in a company and it was doing well, but it's gone through, let's say, a slump for whatever reason. And they're in this crunch where they have to raise money or they're sort of dying. I'm sure you would be bothered with the capital efficiency part of it, but for some reason they have to raise and there is some light at the end of the tunnel, but they're in a pinch. How do you then help your portfolio company raise that money? That's always going to be a challenge, right? What do you do in those situations?
No, those are tricky situations and every brand and business goes through a couple of near-death, situations.
Yeah.
So there, as I said, it comes down to, and that's where I said, even before investing, we should like the founder and that trust has to compound.
Yeah.
Like I talk about an example, unpack, which is the largest cold-pressed oil brand in the country. They had a situation like that, right? And this was an investment that I led. Now they're doing phenomenally well. But there was a time when they had stock that had a lot of defects, etc. And they had also overstretched themselves in terms of growth targets. So they were on near that situation. But at that point, we chose to invest in them. That was because of that trust we had in the founders, and we knew that it was a blip. They had made a mistake, but we had like a clear understanding with them on the next 3-6 months, what are the corrective actions that they'll take. And also some early things already happening, right? Early steps to course correct. So I think the important thing is, when you go through those moments, if you have an investor on board, it helps when you have that level of trust with the investor. Because finally, this capital efficiency, etc., is an important metric. But there it's a judgment call and it's a lot more gut-based.
Yeah.
And having that trust, knowing that these founders will pull this off is very, very important. And as a fund, we're always open to giving our founders one chance at least, right? Because we know that everyone makes a mistake. So that first time you make that mistake, we are willing to, support you through that phase. And if the same mistake gets made the second time, then that is a direct conversation,
Yeah.
And so that's sort of how
Because
we look at
the
it.
reason why I asked this question is, you're clear on the numbers. You're very clear about capital efficiency. Have to have
Finally, that's why I keep joking that our job is almost AI proof because it's largely subjective, qualitative. It's around judging human beings and the interpersonal connection. So it'll be one of the last jobs that gets
disrupted by AI.
so yeah.
How is the landscape of consumer brands in India? I want your take on what's happening. What's the trend that you see next? And what can Chennai founders do? What is that one advice you would say? This is what you guys need to do to get going in consumer brands.
No, I think, in Chennai, the biggest advantage you all have is, as I said, 80% of our portfolio is literally Delhi, Bombay. 80% of our portfolio is just these two cities and then followed by Bangalore. The advantage you have in Chennai is Tamil Nadu is a market that founders from outside don't understand. There are cultural nuances, obviously language, food, everything.
Yeah.
You know what I'm saying.
Yeah.
So you clearly have a home market advantage that you can capitalize on. You can absolutely be sure that Tamil Nadu customers better than any other founder, even like the best founders you can think of. Just because, going back to that unfair advantage, right? I think everyone sitting in this room has an unfair advantage of being from Tamil Nadu and understanding the intricacies of culture, customer needs in this state.
Yeah.
It's truly unique. So I would say, the easiest thing would be to just start with focusing on Tamil Nadu and how you can really build salience and dominant market share in this market. And then maybe you can go to a Kerala, etc., and build from there, right? Because every other brand, like including our portfolio, Tamil Nadu is one of the, all the states that they cater to. And more often than not, try and, copy paste the playbook from rest of the country till they learn and start adapting. But even then, I think someone starting from here will always have a massive edge.
Of course.
Right? And then you can just build it brick by brick and go from there. But I think just in Tamil Nadu, running 100, I know of, this is not a portfolio company, but I know of a beauty and personal care brand called
Veeba, yeah.
They're based out of Coimbatore. Yeah, very strapped. Going back to, again, being capital efficient, etc. Very big. Mainly catering to, like Tamil customers.
Tier 2, Tier 3, yeah.
Yeah. So yeah, it's like, that would be my advice. Just start focusing on Tamil Nadu, conquer Tamil Nadu before anything else.
Made in TN for TN, I guess.
Yeah, absolutely.
Why do you think the consumer brands space didn't pick up in Tamil Nadu? Because Delhi, Bombay, you're saying it worked. They have most of the brands. Do you have any idea of why?
No, I think I answered it before, which is it needs that flair extroversion. I think Tamil Nadu is still on that engineering, medicine track and chasing intellectual pursuits. And then consumer tends to be looked down upon. It's not as intellectually satisfying, right? So that is like my hypothesis, and I think I'm quite accurate about that. Because I don't think it's a matter of lack of talent, etc. It's just that people haven't applied their mind to it.
Okay.
A consumer is not rocket science. Okay. I know it's, I can tell you that. It's just a lot of common sense. And as long as, people start applying their mind to it, you will start. Now there's an Indus Valley, there are a few more brands coming up.
Yeah.
And as people see their success, and now with AI, I'm sure people are thinking about more real world things. So I expect that to change.
Awesome. I think we're done. I mean, I'm out for questions. I just have the like a little bit of a rapid fire, and then we'll open it up for questions. Okay. So I mean, these are just fun questions. But favorite book? What do you have?
Favorite book? No, right now I'm reading all the time or.
I mean, now.
Okay, so right now I'm reading is Jiddu Krishnamurti, Freedom from the Known. It's a psychological more of philosophy rather. But one of my all-time favorites is the Poor Charlie's Almanac. It's the book on Charlie Munger.
Okay.
He's one of my biggest inspirations, not just in investing, but in life.
Okay.
Because starting out, just a personal sharing, a personal vulnerability. I am more of a soft-spoken guy. Most of the investing world has these aggressive alpha personalities. So I wasn't sure whether this was a profession for me. But, that was one book that gave me a lot of confidence.
Oh, really?
Right? That, again, he just speaks about how there's no one way. Finally, it's about playing to your strengths and just chasing your passion.
Okay.
So
Great. Do you have a favorite investor that you've looked up to?
I think it's Charlie Munger.
Okay. Great. One anti-portfolio company that you regret missing?
One anti-portfolio, I think minimalist would be that.
Oh, really?
Because we had the chance to invest in him, but the valuation at which he raised was always higher than what we were comfortable with.
Okay.
But that's a learning again, sometimes you have to stretch. Yeah.
Got it. Top 3 consumer brands that you love that are not your portfolio, like in India right now.
Top 3 consumer brands that I love in... You mean Indian brands that I'm...
Yeah, Indian.
The sad thing is, we are invested in so many brands that, I end up investing their products and I don't, I don't use competitor products. It's almost like, that's like the occupational hazard. So I'll really struggle with that.
Yeah, but go ahead then with 3 brands that you...
You should use that. I said one thing and it's out.
So it is like, for instance, Secret Alchemist is, I'm like, and we use Sleepy Cat. Sleepy Cat is our mattress brand.
Okay.
And Ugao is our plant and gardening brand. We have a lot of plants in our home and you won't believe the scale of the brand. I spoke about pets being the category of the future. So we have this line where we say, pets are the new children and plants are the new pets. So you will see plants increasingly in homes. After this, when you go, you will see, including airports, all of that. It's an integral part of interiors right now.
Got it. Okay, so between domain expert or a GTM guy, who are you backing as a founders?
That's a tough one. As I said, I think as long as the founder spikes in one of those dimensions, I'm okay with it. I don't think I have one preference.
Yeah. And between seasoned or new founder, do you have a preference?
Seasoned founders are safe bets, but it's more exciting when you work with new founders.
Yeah.
The journey is very exciting. Adventurous.
Yeah. And I mean, the last take, because you already actually explained on AI, because that was my last, but we see a lot of these consumer brands start online and then move into an omni-channel and start having an offline presence. Is that the way the trend is? What's your take on being online first, omni-channel, or if omni-channel is the only way or retail is going to be the final say, why not start that from day one? What's your take on that?
No, again, as I said, one thing that's important for all of you to know is the most precious resource for a founder is not the capital, it's the founder's mental bandwidth. And the more focused it is, your chances of success are that much more important. And each channel has its own GTM, everything from new product development. As I said, this is not software. Here you're selling physical product.
Yeah.
So the product development, the SKU sizing, price pack architecture is very unique. So my recommendation always is to focus on one channel. And again, you may not know what that channel is on day one. So try out 2-3 channels. And then whichever channel is showing early signs of traction, just double down aggressively on just that one channel and get to a salient market share in that channel. Salient market share for us typically is at least 10% of what you're doing. And once you get there, then you can think about other channels. Offline, I think, these days we recommend our founders to get in much later. You can probably, there are a lot of brands in our portfolio that do upwards of 200 crores just on digital channels. So I'll say at least that 0 to 100 crores can largely be in the online world. But offline, you can experiment, just maybe have 1-2 people just figuring out that channel, because that channel takes time.
Yeah.
Like a Veeba or a Sula and all were built in the offline world. It is a slow build. It is a micro market by micro market build.
Yeah.
So I would encourage looking at it past the 100 crore mark. And the other important thing is, do not expect the growth rates of an online channel to happen in offline. That's a mistake that we often see founders make, because that channel grows at its own pace. It's a lot more linear, and please avoid the temptation of expanding nationally way too soon. As I said, if you are sitting in Tamil Nadu, just crack the Tamil Nadu playbook. You should, one metric that we look at in the offline channel is, in your category, you should be close to the category leader in terms of store throughput. Like number of products.
Throughput.
Yeah, that's like the fundamental unit in the offline channel. Till you get that right, there's no point. You've not earned the right to spread to any other market. Yeah. And that takes time. It takes like 1-2 years to figure that out.
Okay, got it. I think I'm done. Thank you so much, Hari. I think it was really, really cool. I got a lot of clarity on consumer brands. I'm going to open the floor to questions. If you can pass the mic.
Amazing session. Thank you for coming. You started off with the David Rubenstein quote, I think.
Not bad. That is right. That is his quote.
Yeah.
That was a quote on investing being the greatest, calling of Mary. I jokes about it. I love that quote.
Amazing. So my question to you is, I just browsed through some of your portfolio. They're all on Shopify. Do you encourage your portfolio companies to invest in tech, or that's not their core thing? They're better off in Shopify or anything else, and they just focus on the, core business. Is that how you advise your portfolio companies? And will you also be open to investing in a tech company that is powering your consumer, companies? Like you talked about AI is like the new electricity. Yeah. So let's say like a commerce AI, right?
Yeah.
Would you back a commerce AI platform?
Yeah, taking the first question, most of our companies, they do have tech teams, but not deep tech, right? They have tech teams to manage their website and, their ERPs, etc. Because I think in consumer, more often than not, the core functions are product, marketing, and supply chain. Tech is not the core function. They're better off leveraging the best at it, and Shopify has done a really good job. So in terms of that, that's the answer to the first question. The second question on whether we'll invest in something like that, it's not a core focus. It's on the periphery. But typically, when it comes to such things, we lean on people, investors that understand tech, and can validate whether the tech is really good. So we would prefer investing with a tech fund that we trust, who can validate the tech aspect of the business, because we don't understand that at all. Yeah.
Go ahead.
My name is Gandharv. I'm building in the wraps and rolls category, a brand called Roll Baby Roll.
Okay.
So I have two questions. Firstly is, obviously, the question was asked by Aravind as well, that how founders find it difficult in terms of the consumer space, in Chennai to have access to VCs. It's great to have you here, but we still face that challenge. You understand, build in Tamil Nadu is definitely good, but a lot of VCs look at a multi-city, multi-state kind of an approach. So my question is that how can founders, break that barrier and connect with more VCs in the consumer space, so they can look at brands which are coming from Chennai? I face that, so I asked that. That's one. And the second thing is in terms of the trends. I'm in the food space, so I'll say biryani is not a trend, right? Wraps and rolls is not a trend, but something which has sustained over the years, like you spoke about the toothpaste, and it will sustain. So founders who are building in this category, what's your take, or what's the fund's take on, categories which are building in this? So brands which are new age brands building, old age products in this.
Sure. I think the first one is, I think that is slowly changing, but, I don't know what the challenges have been for Chennai founders to reach out to consumer VCs. Is there any specific challenge?
There's there are. I mean, if you can keep a Chennai office, I think it'll be great.
By God's grace, I can say that I'm allowed this stats.
if I would say the backdrop, I feel I would have access to capital much easier, right? If I go to BC, they want to see a multi-city approach. But like you said, being focused in one city, expand your bandwidth, that makes sense in terms of, we are more fiscal prudent, our Chennai founders. And I'm happy to say that I've been able to do that. But now, obviously, to go to a new city, you need to go with a certain bandwidth, certain strategy. And for that, you need money, right?
Now, the challenge is, if I can sum up, is in Bangalore, if there's the brand, there's enough brand recall in the VC environment. Here, like, people love Roll Baby Roll. People love what Stalin does because we are very, like, we are in one ecosystem, right? So it's an ecosystem problem also. Naturally, if Roll Baby Roll was there, it would have probably had 2 rounds of funding by now. Is sort of what we're trying to get upon.
Right.
It's also because the risk capital people are not here very the access is less.
Right.
Or the kind of focus that they give to Chennai is also a little less.
Right.
Yeah.
The VCs themselves do not have the first hand
Your
awareness.
portfolio is having one company, you're getting on with the second one. So that also says you're the largest consumer fund in the country. So that says it itself, right? So how we can work, all of us together to kind of change that perception. Obviously, it'll happen gradually over time. It's not something which will change overnight. But yeah, something we would all like.
If you can open a door.
The doors are always open. As I said, from my end, I always thought of it as not enough consumer founders in Tamil Nadu, right? Because while we have so many companies in rest of India, we would have seen like 100x of that from rest of India. From Tamil Nadu, maybe I would still say not more than.
Put in perspective, Tamil Nadu is the state which has the highest number of restaurants abroad from, if you compare from a Delhi, Bombay. Yeah, just to put things in perspective, because adaptability and acceptability of international investors to these brands or these products has been much higher than other cities.
Yeah.
So,
For one, sorry, just to add to that, I Manish Tiwari, who used to head Unilever. Unilever's new, what is it called? Unilever Ventures. Unilever, yeah. No, before Unilever, he was heading the modern trade. The modern trade division of Unilever. So I sold his floor to him at the time. So that's why I knew him. So one of the things he used to always say is, when Unilever comes up with a new product, they use Tamil Nadu as actually the launch market. Right? But that says a different story, right? What is the disconnect?
No, that's a good point you made. Because the reason they do that is Tamil Nadu is very easy to isolate. In terms of budgets, etc. If you have to spend on like a Hindi GEC channel, it'll be 10x of what they would have to spend if they launch only in Tamil Nadu. Because Tamil Nadu, at a fraction of the budget, you are able to have similar reach, salient reach, and then if the product works or not. So that's the interesting conundrum. So for me, that's something we tell our... Correct.
Yeah.
Exactly. That's what I'm saying. So
After first they reach 4-5 crore people. Yeah.
So that's the school of thought I come from. But I think as long as your metrics are best in class, so in your apps, and please share the details with us, and we'll be able to give feedbacks. There's no reason why a VC fund would not be interested, right? I'll be surprised if someone has a negative bias because you're starting from Chennai. I could be wrong, but at least I can speak for ourselves. We don't. We only care about the metrics. If it is like best in class of what we know in QSR, it's an attractive one. And I forgot what your second question was.
second question was about a product which has been around.
On old age products itself.
That is an interesting question. There are few levers, you can play on. Typically, the next generation doesn't like using the products used by their parents, etc. There's always, it's seen as old age, so you can always play on the coolness quotient being most relevant. So that is, if you can upgrade the product, that's like the best, and people's palates are also changing. As I said, like these days, most of the kids, they find stuff that you and I would find normal to be too sweet. So the good thing is human beings are always changing. So you just have to be on top of that. And if ideally you can bring a product difference, that's absolutely great. If not, making it cool, more around storytelling, Gen Z relevant, all of that. right? So that's how I would think about it.
I think both work. Like, for example, there's a product innovation that you could do, and also the next generation wants another brand in the same market. For example, in Tamil Nadu, you would have like a Talapagatti biryani which dominated, and now the Talapagatti space probably taken by Junior Kuppanna. And we had a Buhari, and now Bilal is taken. So every 10 years, the brands also get recycled for those establishment positions, if you really think about it.
I want to go back to the same Tamil Nadu founder. This is serious problems. I was talking to Bala Panikkar. This is a topic that we keep talking. I keep talking at least to all the people that I know in the startup circles. One of this thing he said is like, the Tamil Nadu founders, at best they can succeed in the South India. And they seem to...
I told him already.
And they seem to be not understanding the cultural nuances of the North India because it's a Hindi belt. And so like the South Indian culture seems to be a bit different, although the language differences are there, but still it is somewhat homogeneous. But the North Indian market is very different, and we don't seem to understand the nuances of the North Indian market. The classic example is even Milky Mist. It's one of Anikkar's investment, right? So Milky Mist is a very powerful brand on the south, but in north is still Amul. Right? It's very hard to beat Amul. So how much of this is also relevant, especially in the consumer brand? In tech, I don't see that problem. For example, a Zoho is able to go to north.
Right.
We have a lot of North Indian customers for KissFlow. We have no problem with Freshworks. So for tech, we are able to go across globe also right now. Yeah, it's actually global brand, right? So, but for consumer brand, is it a big barrier for us? And how do we sort of fix that?
Sure. We actually spoke about it, and he gave the example of Carrot Lane, and I was talking about Indus Valley and our own portfolio that has done well. But that is a valid point.
Indus Valley sell well in North.
They do. But the fact is like 50-60% of their revenues is from the South, but North is very relevant for them as well. And it is a scaled up brand. But the point you raise is valid. You know, the same reason why people outside Tamil Nadu struggle with Tamil Nadu, it works the other way also. And the simplest way to solve it would be to make your teams inclusive, like hire people, nothing like hiring people from rest of the country, otherwise we'll again be operating with second hand knowledge, right? So it is important to have leadership from other parts of the country, either in Chennai or maybe open an office in another city. Those are like the simplest solves. So as long as there's someone feeding in, that perspective, you can bake that in. Otherwise, if you're 100% just people from Tamil Nadu, then you will be facing these challenges. So that's
a very good point.
Even yesterday, Hari was telling me, Pickerdale, 60% of his revenues relative to the population of South India comes from South India. Only that.
Which is not a bad thing. As I said, that gives you that initial jump start, and you can scale up significantly just catering. But as you start focusing, training your eyes on North India, you have to have people from that part of the region in your leadership to help you navigate that market.
Awesome. Next, guys, can we go forward? Yeah.
Hi, my name is Sabir. I run a tech fruit Colorx bots. So,
Hi.
I'm
We are considering work on the pet care segments.
Thank you.
So my question is, how do you see the channel dynamics evolve, especially the offline sector? That's one. And any early learnings on what SKUs or price points typically work in quick commerce? That's my question one. The second question is, any deep consumer insights that you found recently which surprised you?
Okay. No, the first one in terms of price points on QCom, if I look at some of our larger brands, the learning has been the premium SKUs do phenomenally well. Like even in an Epigamia, as I said, like if we draw a price spectrum and the products, the ones in the upper half are the ones that fly off in the QCom channel, because most of the consumers in QCom are price inelastic, because they don't even care about the delivery fee, etc. So that's a channel where I would suggest you can focus your premium SKUs on. In terms of counterintuitive consumer insight, nothing that is top of mind. If something pops up, I'll get back to it, but I can't think of anything of late. Yeah.
Great. On the offline side, how do you really see the channel that is?
That, as I said, the fact is modern trade is under a lot of pressure. QCom is taking share away, especially from modern trade. And then that's where, I would suggest, if you are off to a good start in the online channel, 0 to 100 crores, better just focusing on that channel. If you had started your journey in the offline trade, then I think between GP and MT, which is general trade, modern trade, if I had to pick, I'd prioritize general trade, because modern trade is the one where the future is very hazy, because that's the one that's getting disrupted properly by QComs. GT, I think, will still, not be disrupted as much.
Do you see larger pack size in moving with commerce?
I think, eventually it might happen, but it may not be part of the 10-minute delivery. It may be same-day delivery. But, as I said, even an Amazon is reworking its supply chain to build it as a QCom company. So if it's a larger SKU, maybe you will be in the one same-day delivery bucket and not the 10-minute or 1-hour delivery bucket. That we know from like the leadership. So
Yes. Next, please.
Yeah. We are in the mission of making the trust as a broker marketing capital, and right now we are Hariharan 100 marketers. We having an experience about getting to 5,000 groups. Other founder of Salt Turkish is in brand respectability. I spoke many agencies and many founders, specifically, particularly early stage, particularly the 5 to 10 crores. Many founders are stopping to find the right channel, right product to scale using either the right market or right people. Because even for the 10 crores, they know, because Unit was saying that even people can scale their brand, focus in a particular category to up to 500 crores. But in terms of people visiting you or approaching for the fund, you may cross over the same category, even for the same market, for the same brand. So what will be your preference of the big map out of very founder?
the last part I didn't catch completely.
I mean, I think you're basically saying if a founder approaches him in a category you've already invested in,
Oh, in a category where
you've already interested in, what would they have to tell to convince you to say, okay, we'll still go for you? Is basically what he's saying.
as I said, as long as you're not taking that brand head on in terms of price point positioning, one thing I miss mentioning is, as we assess brands, one of the things we try to answer is whether a brand can truly own a positioning in the minds of the customer, right? Because any brand, if you think of an Epigamia, etc., Greek yogurt pops in your head. Yeah, it's that mind space. All the brands are fighting for a person's mind space. As long as you're not fighting for the same mind space that another brand in the portfolio, like for instance, if you are launching another clean perfume, we are already in Secret Alchemist, right? But if your positioning is clean perfume for men, I'm just making it up, we'll be okay. But if it's again generic clean perfume, same as Secret Alchemist, then you're like literally taking them head on. It can also be clean perfume for just Tamilians. I'm just making it up.
Kids will be better.
Sorry?
For kids.
Okay.
Correct. There are like so many ways you can cut it. Correct. So it can just be, like for instance, I met a brand that makes like perfume not for your underarms but other body parts, right? Like you can slice and dice how many ever ways you can want. That's the beauty of consumer.
I think it's conviction at the end of the day.
Sector focused VCs might do that. Like
Correct.
they might invest in all the
Correct.
companies also.
Correct.
Yeah. Okay. Thank you. Can we move on? Can we please have some women ask questions?
Hi, I'm Nireda. I'm Hariharan and the founder of the Mine is Downbeat. So we have a niche that's platform. I have two questions to you actually. Thank you for the amazing session. It was really candid. But I saw you talk a lot about products, but not service industry at all. Is there any reason as to why you did not pick service industry as my first question? The second one, with respect to the mental health industry, do you think for emotional wellness, people will start spending on a preventive basis, say for example, bookkeepers, etc., or will it always be a crisis spending? Like, wait to ask.
Sure. I think maybe you joined slightly later because I first spoke about my first investment, which was in a childcare brand called Clay, which was as services as it can get. And the fact that we do invest in services, you can scale services businesses profitably. So we are completely open to, investing in services business. But the fact of the matter is, most of our businesses are product business. That's why maybe, subsequently, all the examples were product related. To your second question on, that's that classic paracetamol versus vitamin question. It is definitely more harder, when you're selling a preventive, proposition. As I said, that's where if I were evaluating you sitting in the pitch, I would ask myself, do I see myself being a user of this product before the need becomes acute? What is your messaging, articulation, etc. Right? So you will have to work harder on convincing people on why they should, look at it way before it becomes acute. But I think mental health is a big opportunity. I just think you have to figure out what messaging lands well with the consumers for them to act sooner. So yeah.
Thank you. Next, please. I think we'll have like 3 more and we should be done. Yes.
Is really good at identifying consumer as the least usage with the unorganized organized segment. But Jopi is one success when it's completely unorganized sector or practitioner happening now. But you don't have any two on that. Is what it your investment pieces or what is your take one? Julia.
Yeah. No, good question. So within consumer, we're even more narrowly focused. And the sectors that we invest in, 90% of our investments are in our packaged food, beauty and personal care, pets, travel and experiences, and home and wellness. Like 90% of what we do is just these 5 sectors. And as you would note, I've not included jewelry there because it is a low priority sector for us. The fact is, we don't understand fashion. In my past life, I've lost money in a fashion investment, and I know many investors and amazing founders lose money in fashion. It's just a very hard category. Doesn't mean, like we just give the example of Carrot Lane. There are people that do well, but just the consumer behavior is so unpredictable in fashion, so qualitative and fast changing. We've not been able to crack that. So we have enough to do in the other sectors. So it is a low priority sector for us. Yeah. But the opportunity is there. There are funds that invest in fashion. People talk about like the Jivas of the world that have done well. So there are funds that we will not be a fund if you're in fashion. We just don't understand that segment.
Got it. Next.
Hi, Hari sir. I'm Trivikram. I'm a chartered accountant. I'm a research fellow from a venture capital named VC. Thank you for your insightful conversation. I have like 2 questions for you. So the first question is, you mentioned that no stage is early when you have a strong category conviction. So from your perspective, in the current, at this point in time, what are the categories that are there in your high conviction category bucket that you see on a overall trend of a long-term tailwind perspective? That's the first question. And the second question is, I want to understand your opinion on this particular issue of profitability that is, based on a post mentioned by Shashank Mehta, the founder of The Whole Truth. He mentioned that he is not, profitable at this point in time, mainly because of this one insight. Like he said, like personal care has an, industry average gross margin of, 70%, apparel at 80%, beauty and makeup at around even 90%, but food comes at a princely cost of, say only a margin of 40%. And the main reason he mentioned that, the point was that people are ready to splurge on things that they can flaunt outside there. splurge on, say, skincare, creams, and anything that makes us look good to others. When it comes to something, when you put inside, even if you're passionate about creating a brand that's the clean and the ingredient on the transparent space, are people ready to pay a premium for it? Because considering there's like the whole truth is not yet profitable, and the founder himself is mentioning that he's facing this issue. I want your take on that and opinion on this.
Sure. On your first question, I just covered the sectors that we are bullish on. So we are bullish on all of them, which is FMCG, packaged food, beauty, personal care, even F&B like QSRs, etc. Then pets, travel and experiences. So travel, experiences, entertainment is like our anti-AI theme. You would have heard about this as people. Yeah, we are in Stay with Star. We also invested in Wanderon, which is a group travel company. But the whole point is, as AI takes over, people will have a lot more spare time and productivity will go up and they will spend on experiences, entertainment, all of that, right? And then home and wellness. So these are pretty much the sectors we continue to be bullish on. There's a lot to do. Your second question, that's very relevant. Each category operates at a certain gross margin. Food is in that 40 to 50%. But I know of so many brands in our own portfolio that get to profitability, even at like a couple of 100 crores, right? So it's not impossible. Obviously, lower gross margin means. Yeah, that is correct. Correct. It's not actually an issue because, like we spoke about Sleepy Owl. Sleepy Owl today is profitable at 100 crore top line, right? So it is it is definitely you're working with lesser gross margin, but also in food.
You play a volume game, right? At the end of the day.
the context
You play
is
a
also-
volume game then, right? At a lower
Volume game is one part, but the other flip side to Shashank's argument is that BPC also has a lot more competitive intensity than food. It has higher gross margin. As a result, there are more founders starting up as well, right? Yeah, but in Epigamia, as I was explaining, the main challenge in Epigamia was not the gross margin, it was the cold chain and expiries in the offline channel, right? So if it is an ambient product with a 40% gross margin, in food, in my view, you can get to profitability in that 100 to 200 crore ballpark. Yeah. So it's absolutely. No, I understand, but I can tell you, I can quote enough examples of packaged food brands that are profitable in that 100 to 200 crore ballpark.
Thank you.
He particularly mentioned that organic food cost is very. He said it's not a GK asset, it's not a human capital cost, but
sourcing become. Sourcing. Yeah.
So, I'm talking about if you have a 40% GM, Shashank is a good friend. I don't know where his GM is today, but as long as you have a good GM, getting to profitability at 200, 300 crores is not a challenge.
Doable.
And we have like one profitable at 100 crore top line itself. Yeah.
Sure.
And also, when you have something like organic, the GTM becomes little easy because the word of
Right.
mouth.
Absolutely.
Yeah.
Yeah.
Hi, this is Arvind. So I used to work with Macro.com and Pitex. So I have a Veeba sheet. What leads you to do investments for Cheque and accelerates and really less bad.
Yeah. So again, funnily, a lot of investments that I did not lead. Cheque was led by my Southeast Asia colleague. And Leverage EDU I can talk about. It was before my time, but I know I've been working with them for a fair bit. So for those who don't know, Leverage EDU helps students apply to universities abroad. So think of it as a digital first student counseling platform. There the thesis is, in the past, China was like the biggest supplier of students globally. But going forward, as you know, China is going through a population stagnation. Yeah. It's the Indian students that are going to travel the most globally, right? And for us, Leverage EDU was like the platform that could be like the market leader in that. And Akshay has built that company beautifully. And he's where he is. Actually, related to that, even when it comes to travel, Indians are set to
Travel the most, yeah.
travel the most, and that's the opportunity. Everything from hotels to services to products that you use in travel. There are a lot of opportunities there.
Yeah. So I think Ashna has a question. Yeah.
More like a summary of the entire conversation. As a consumer batch is running navigating to hear you. My curiosity is, I quit my podcast job 10 years ago from Tisai and I give a farm and started my knowledge farm, private shop. And it's organic, heavy on wings in the right space. But this is a common thinking I learned is one, I do all the right thing and all, but the sector is not scalable. Yes, so the problem we're solving is very here and the future. We all want safe food, we all want chemical free food and all, but handling perishables is a challenge, right? So everywhere we go pitch up top people, they turn out in the consumer brands fine, but you can't scale beyond on point. That becomes a question last. Second, I see like the matter investor all the farm to the home companies. Like I see family oriented, but if you talk of any brand today doing this farm to home in the space, I think the biggest award has come from Veeba or research and no to turn in there. If we have to approach at the Ashaka can build intro, but still I curious know why you allow me to tear apart to go out this day because it's yeast food, right? Yeah, other packaged things. Most of the these have foods restaurant already.
Right.
But why not that?
No, we have looked at a lot of farm to home companies. I think the answer is like you sort of told us. The issue has been this, perishables and a lot of wastage and unit economics being challenging as well. So that is like one part of the equation. And the people that have got it right in a particular location, sometimes we don't know how scalable the back end is. So usually one of these two reasons is why we passed on, most of the people we met. We are very particular about businesses that we think can be capital efficient. So, in your case, if after wastage, right. Then I think, please share the material and, we should be able to share the feedback.
I think everyone right now are thinking, am I capital efficient? No, that's the only conversation.
The room when that's one metric, I think.
But they're all going to be like, I put 1 crore. What is my revenue right now? I think everyone's. Yeah. But I think we'll have our last question and we're done for the day. Yeah.
Very refreshing session. Appreciate the site. We actually run when in the kids OSEC. Client is called Feature. My question is basically like I know like brand forms where a lot of people keep coming back and buying over it. So repeat becomes a very important metric sort of drag. And like you mentioned, 0 to 100 pro journey would make a lot of sense if you're focusing on one channel. But let's say online, for example, people that both channel, right? Where inherited subcategories would not be the repeat or resale fashion, which could be that is a little bit on the higher AOV side. You could take that maybe Sleepy Cat get some for that. And then super high acquisition costs way off. So what is the right kind of a playbook to sort of solve for a brand from this aspect? Considering you also have one portfolio as such.
No, we have you in home. Like I spoke about Uga, which is into plants. That's again home. In home, we've seen, having your own retail outlets is like a very good channel as well. Right from discovery to providing experiences. Sleepy Cat and Uga, all their stores are profitable and doing really well. So I'd urge you to consider, opening stores if online is proving to be not viable. Yeah. So, just experimenting with 1 or 2 stores, may be the right thing to do.
So that would still require some level of high capex.
Yeah. You will have to, raise that money. Yeah.
Omnichannel is sort of where you.
Yeah, in some categories, your online is, as I said, it's not a one size fits all. If online is not working out, then, retail has worked out for like a Sleepy Cat and Uga. So that might be a channel worth considering.
Okay. Thank you, guys. I think we're going to wrap this session. Thank you, Hari, so much. I think it was really great. Thank you for coming down to Chennai and do nice. We'll just take a quick picture with the team. But thank you all. We'll take a quick picture.